good morning, and we are on the second day of Ind AS 1, presentation of financial statement as per Ind AS. In the last session, we have actually took an overview of the entire structure of how the flow will be happening, including what is the origin of Ind AS, how we have converged with IFRS, and what are all the carve-in and carve-outs compared to IFRS, and what is the numbering process which we have adopted. If it is an IAS series standards, we said that it will be Ind AS 1 to 41. If it is an IFRS standard, we said it will be Ind AS 101 to Ind AS 116. So we have seen that numbering pattern as well. And we have also seen what is the component of financial statement when we are talking about the particular situation of the Ind AS financial statement. For example, we have said that the financial statement will be having 5 components. A new component is nothing but the statement of changes in equity, right? And we also discussed about every financial statement requires at least 1 year of comparatives, and the companies give comparatives, and in that case they have to disclose the other comparatives as well. So when we are talking about the situation, we also took a little bit of case studies from our institute study material for you. Today we will be discussing the balance portion of Ind AS 1. Especially the discussion will be on the basis of the Schedule 1, current and non-current classification. What are all the rules which has been given by Ind AS 1, as well as how the presentation and disclosure are there in Schedule 1. So we have discussed about Schedule 1 also, which we said that it is notified under Section 133 of the Companies Act, and it is also part of the Companies Act itself. So this is the thing which we have covered previously, and we will continue with our discussion. And whatever question which you are having, I request you to post those questions in your chat box, so that I will download the questions maybe before we break for convenience break for 5 or 10 minutes. I will first download and see that, so that the flow of the discussion will not get disturbed, because some of you have suggested that the questions can be taken at the end of the session. What I will do is I will take the questions before the break, and then balance I will take after the session is over. This is the way in which I will try to do this entire discussion. Feel free to post all the questions, because I have seen that when you are posting the questions, I have already answered those questions by means of examples. So those questions I need not repeat again. That's the reason why I believe that the suggestion of some of you to take the questions at the end of the session will be a better choice. Okay. With that, let me get into this balance portion. We are on comparatives. What do you mean by comparatives? Every user should understand, when you are presenting a financial statement, what is the current year number and how it was in the previous year. When you compare the current year number with the previous year number, the user will be able to understand how the changes has occurred over the period of time within the entity. And when you give 2 years, 1 year comparative, that is the current year number and the previous year number, not only within the period they will be able to compare, they can also see the trend of what is the changes happening in the assets, liabilities, income or expenditure, even on cash flow statement, compared to other entities. That's the reason why comparatives is always preferred to be given. Comparatives is not new to us. Even under our normal presentation, even without Ind AS being part of that, we used to give 1 year comparative. And accordingly, you are familiar with what do you mean by comparatives. Interestingly, when you have a financial statement, there could be numerical information which you have given. There could be narrative information which you may be giving. For example, when you are saying numerical information, in the balance sheet, current year numbers are numerical and comparative number will also be on numerical. When you go to notes and accounts, you may be having a narrative information of in the previous year, the company was having some forward contract, and during the year, the company is not having a forward contract because they have changed the method in which they are hedging their risk. So I'm giving one example. So when the narrative information is coming in, current year something is not there, but the previous year something has been given as an information to the user of the financial statement. It is expected that you give an explanation of what has happened in the previous year so that the user of the financial statement can be easily understand what is what. That is exactly is the requirement of the comparatives when we are talking about under this particular standard. So the first thing which we are talking about is what is your comparative in respect of numerical comparatives. It expects minimum of 1 year, at least one previous period should be given. So if I am talking about 31/3/2020, you should give at least for 31/3/2019. That is the expectation which you are supposed to give. The second aspect which we are talking about is, in case of narrative also, the description of the information which you have given in the previous period and what is not there in the current period. That could also be one possibility. This year you have added some narrative information, but it is not existing in the previous year. So you would be requiring to explain that this is for the first time it is happening. So comparatives is both for numerical as well as for narrative. And when we are talking about the balance sheet, somebody has asked this particular question in the last session. I said that I will take it at the appropriate time. Whether comparatives has to be given only for the previous year, 31/3/2020 is the current period, whether it is required only for 31/3/2019, or I have to give for the opening period also. What is the opening period for 31/3/2019? It is 31/3/2018, or maybe I can say 1/4/2018. Whether I have to give any number for 1/4/2018 also is one of the question which has come. We call that as a third balance sheet, because current year number is the first balance sheet, comparative is the second balance sheet, and you are giving a balance sheet as on the opening date of the comparative period. In our example, it is 1/4/2018. When you give the third balance sheet, when it is mandatory, because the standard says it is mandatory only in 3 circumstances. In all other cases, it's a comparative which the management decided to give. 1 year comparative is at least required. So if the management wanted to give 1 more year's comparative, management is permitted to do it. In that case, that is not coming under the third balance sheet criteria. When they are giving the comparative, they are giving on their own discretion. Whereas here, it is a mandatory requirement that an entity should present a third balance sheet. Please understand, I am talking about third balance sheet alone. Even though we have a component of statement of profit and loss, statement of cash flows, statement of changes in equity, we are not talking about giving a third balance sheet with comparatives for the third period. Only in the balance sheet it is made mandatory to give in 3 circumstances. Out of the 3 circumstances, you will understand that one of the circumstances which we are talking about is change in accounting policy, and the second is if there is an error in the previous year which you are correcting. You might have already gone through another session, or maybe you are going through the session. Ind AS 8 with respect to changes in accounting policy, changes in accounting estimate, and accounting for previous period errors, right? In that, they are talking about where you are supposed to do a retrospective application. When there is a change in accounting policy, retrospective application to be done. When there is an error which you are correcting, it should go to the period in which the error has to be corrected. That particular period when we are making that adjustment. So, what is required for correcting it is arising out of only 2 situations. If there is a change in accounting policy, if there is an error which you are correcting. The error can be of 2 possibilities. One, there is a classification error. That means an item which has to be shown as current asset, you might have wrongly included in non-current asset. You are now reclassifying that. That could be one possibility. And another possibility could be there is an error in accounting itself. Instead of treating a particular item as an expenditure, you might have capitalized. That could be another possibility. So in both these three circumstances, you are supposed to present not only the comparative period balance sheet, but also the balance sheet as at the opening period. The logic is very simple. If you see that when I'm applying an accounting policy, I should apply on a retrospective basis. That means I'm going to restate all the numbers. If the accounting policy is to be applied, assuming that the particular transaction has started 5 years back, so 3-year cumulative impact will get adjusted in the opening retained earnings of the comparative period. In our example, assuming that it has happened somewhere in 2014, the accounting policy is applicable from 2014 because today the policy has changed, but the particular transaction has happened from 2014 onwards. So from 2014 to 2020, I have to adjust that figure. But what is the current year impact should alone be coming to my P&L account when I am doing a retrospective application. What is relating to the previous year comparative period will come to the line item of the profit and loss account and the balance sheet line item. Consequent item will be on balance sheet. And the balance 3 years impact, 2015 to 2018, cannot be adjusted in any of the line items, right? So only possibility is it will be adjusted in the opening retained earnings on the balance sheet. The opening retained earnings is coming from 1/4/2018. So entire impact up to 31st March 2018 will adjusted in the opening retained earnings whenever we are applying that. But the opening retained earnings is already reported to the stakeholders of the entity. The moment I'm saying it is already reported, but I'm going to change that number, the user should know what was the previous number, what is the change, and what is the revised number. So there is a requirement to show the third balance sheet in particular situation. Whenever there is a change in accounting policy, you will read that in detail in Ind AS 8. And the second is, there is an error which has happened, which requires a retrospective correction of the errors by restating the items in the balance sheet and the profit and loss account. Maybe the error, assuming that the error has happened in 2017. The first adjustment which has to come is on 1/4/2018 because it is an error of the previous year before the comparative period, right? So we have to take it into consideration. Whatever error happened before the opening date of the comparative period should be adjusted in the opening retained earnings. When you restate that number, you have to explain that. For example, if it is error is relating to 2019, then you will readjust the line item of the P&L and consequential line item of the balance sheet. So both will also be restated. But 19 financial statement has been already adopted by the shareholder, but changing the numbers. When you change the numbers, you are duty bound to explain to the users why that correction is happening. Okay. That is the reason why when you are restating the number to correct the financial statement on a retrospective basis, normally it happens only when there is an error according to Ind AS 8. And sometimes you are retrospectively reclassifying. As I have given an example, you are supposed to show an item as a current asset, but you have classified as a non-current asset, which gives a completely a different picture. So now you are correcting that particular item, going back and correcting that particular item. When you correct that particular item on a retrospective basis, users should understand what are all the changes. And normally the presentation will be like that. What is the number as per the audited financial statement in the previous year? What is the corrections which you have made? And the corrections will have a note, cross-reference to that. What is the revised number? That revised number will be matching with the line item in the balance sheet which you are placing. So the third balance sheet is nothing but, apart from the comparative period, you are also producing or presenting one balance sheet which is on the opening date of the comparative period, right? This is required only in these three circumstances. There is also possibility when you are giving a comparative statement, more than 1 year comparative also can be given. It's a discretion of the management. But interestingly, what the comparative paragraph says, suppose if an entity wanted to give only balance sheet for the third period, it need not give the comparative for the other components. That is exactly what it says, is that other components of financial statement may contain only 1 year comparative. For example, voluntarily I wanted to show what is the balance sheet asset 31/3/2020, what is the balance sheet position as on 31/3/2019, which is a comparative. And I also wanted to give 31/3/2018 as a comparative. I can give only for balance sheet. It is my discretion. I need not give for P&L, because the user, the entity may be thinking balance sheet is undergoing various changes, and that should be given to the users of the financial statement. P&L is not having any impact. So accordingly, it is left to the entity when it gives more than 1 year comparative, which component they wanted to give. Some companies will give balance sheet only, current year and comparative period. P&L they wanted to give 3 periods. So they may be interested in giving. Cash flow statement some entity may be giving. So which component of financial statement they wanted to give, that is left to the discretion of the entity. And other components of financial statement can contain only 1 year comparative. But normally when somebody is giving, this is actually prescribed as per the standard. But normally what happens is, if an entity wants to give a comparative, they will normally prefer to give comparatives for balance sheet, P&L, cash flow statement. That gives a conclusive information to the users. But the law says you can give only to one component. Other component need not have. It is only left to your discretion. This is one thing which you have to keep it in mind. If you are planning to give 1 year comparative on a voluntary basis, additional 1 year comparative on a voluntary basis, that should be very clearly explained in the notes and accounts. That legally it is required to give only 1 year comparative. The entity wanted to give 1 year comparative voluntarily. What is the reason for that particular discretion? You have to explain that in detail. This is relating to comparatives. More than 1 year comparative can be given. That's what we have already said. Only for that particular component, detailed notes is also required to be given for the period when you are giving a voluntary basis. Now, when we are talking about the financial statement identification of the financial statement, normally you are expected to show name of the reporting entity to identify the financial statement, whether it is a standalone financial statement or consolidated financial statement. For example, XY Limited. Then the next line you are saying consolidated balance sheet asset, consolidated statement of profit and loss account for the year ended so and so, consolidated cash flow statement for the year ended so and so. You can, in case if you are going to talk about standalone, then say XYZ Limited standalone balance sheet asset. The only question which comes is, I do not have a subsidiary, I do not have an associate, I do not have a joint venture, and accordingly I do not prepare any consolidated. In that case, whether it has to be specifically stated standalone, it is not required. Only if you are presenting both consolidated and standalone financial statement, user should identify whether it is a standalone or consolidated. So the nature of that should also be explained further. And what is the reporting date or the reporting period? When I am saying reporting date, balance sheet is the reporting date. For statement of profit and loss account, statement of changes in equity, statement of cash flows, it is for the reporting period, for the entire period. That's the reason why asset 31/3/2020 we use for balance sheet, whereas as for the period year ended 31st March 2020, we use for P&L, cash flow statement, statement of changes in equity, and of course for the notes and accounts also we use. So this is the way in which you are supposed to identify the financial statement. Interestingly, you should also say what is the currency which you are using. Whether it's an INR is the presentation currency or US dollar is the presentation currency, you should also explain that particular aspect. Another interesting point, we have a separate slide on this. Whether an entity can give full number in the balance sheet or it has to mandatorily round off certain numbers. For example, when I'm saying full number, assuming that the fixed assets, property, plant and equipment is 12 crore 11 lakh 12,587.25 rupees. Can I give the full number, or I have been forced to use a rounding off, maybe in hundreds, thousands, lakhs, millions, crores, whether there is a restriction. Interestingly, Ind AS is actually saying that based on the turnover of the entity, the financial statement has to be rounded off mandatorily. We will see in a separate slide so that you will see the number and then do it. So this is actually become a requirement of mandatory under Ind AS. Suppose if you are preparing and presenting as per Schedule 3 for a normal company, it is not mandatory. Rounding off can be decided, because there it says may be rounded off is the word which has been used, whereas in Ind AS roadmap, they use the word shall be rounded off. When you use the word shall be, that means it's mandatory, rounding off has to be applied. So if some of the question which is coming in and say that the entity wanted to give full figures and they have given the turnover also in the question, please understand that there is a mandatory requirement for rounding off the numbers in balance sheet, P&L, cash flow statement, statement of changes in equity, and all accounts. You have to use the uniform unit of measurement. So if I have used lakhs in the balance sheet, P&L should also be lakhs. Cash flow should also be in lakhs. Statement of changes in equity should also be in lakhs. Even your notes should also be in lakhs. So you cannot have full numbers for notes and some numbers for your balance sheet. It's not possible. So this is one thing which you have to be little careful. This is a slide which I have said. I will give the number, then you will understand. For example, it says that Schedule 3 made it mandatory. Schedule 3, and we said that for Ind AS companies, we said Division 2 is for normal companies, and Division 3 we said for NBFCs, right? So this is for normal Ind AS companies. We said Division 2 of Schedule 3 should be used, and for NBFCs it should be Division 3 of Schedule 3. That makes it mandatory. Depending upon the turnover of the company, the financial statements shall be rounded off. Actually, this is wrong. May be rounded off is incorrect. Shall be rounded off is the correct one. So I also tend to correct, because this statement might have been prepared for another presentation where we are talking about the general financial statement. So what it says is that if the turnover is less than 100 crore, the entity has to round off to nearest 100, nearest 1000, lakhs, millions or decimals thereof. That means you can give 2 decimal of in hundreds, in thousands, in lakhs, in millions. What is not there? Here not there is only 2 items. One is full figures is not there, it is not there, and crores is not there, right? In this case, when your turnover is less than 100 crore, you are not permitted to give full figures, and you are not permitted to give in crores. Okay, rounding off cannot be done in crores. Suppose if I am saying it is 100 crore and above, please understand this is 100 crore and above. Somebody has asked the question, it's more than 100 crore or 100 crore and above. So here also the legal term says 100 crores or more. So in 100 crores or more, the rounding off will be starting with lakhs, millions and crores or decimals thereof. That means when I am saying decimal, 2 decimals of lakhs you can give, 100.22 lakhs. If you are giving in crores, you can say 322.43 crores. So 2 decimals you can give. But what is prohibited here? Here prohibited is 1 is full figures prohibited, 2 hundreds are prohibited, 3 thousands are prohibited, and all other things are available. So this is the difference which you have to understand when somebody is asking a question in the examination. what is the rounding off requirement on a mandatory basis as per Schedule 3 relating to an Ind AS companies, right? Now, let us go to the balance sheet and let us go and understand how the balance sheet is being prepared. You might have already seen the balance sheet and it contains asset side, non-current assets and current assets, and on the liability side, non-current liabilities, current liabilities and equity. Understood, I have explained that the assets are first presented. Unlike normal companies where the shareholders' funds, current, non-current liabilities and current liabilities will be presented as a first part of the balance sheet. Here, assets will be presented first, non-current asset and current asset, total of the assets. Then you will have equity, other equity, non-current liabilities, current liabilities. That's the way in which the presentation will be there as far as Schedule 3 relating to Ind AS companies. And if you see, Ind AS 1 is not prescribing any format of the financial statement. It only says that these items should appear on the face of this. That is what it gives a general guidelines. Exact format is not prescribed by Ind AS 1. This is coming as per Schedule 3. So, Ind AS 1, whether it has given format, no specific format. Okay, but the format is actually coming from Schedule 3. Okay. Now the question is, there is a conflict between Ind AS 1 and Schedule 3. Somebody has asked this question in the previous session. What we have to do? And we also had a slide, right? If there is a conflict between Schedule 3 and the standard, we have to see what is the origin. Schedule 3 is coming under Companies Act 2013. Accordingly, that has an upper hand. So the format will be in accordance with Schedule 3 and the disclosure required by Schedule 3 will be in addition to the disclosure as per Ind AS. That means notes on accounts, whatever we are giving as per Ind AS, plus what is the requirement as per Schedule 3 has to be taken into consideration. But the format will be in accordance with Schedule 3 because it prescribes the exact format. This is what you have to keep it for your balance sheet, P&L, statement of changes in equity, your cash flow statement, and of course your notes and accounts. Everything should be based on Schedule 3 requirement because the format is prescribed under the Companies Act. And Ind AS 1 is notified as part of the Companies Act. So the format has to be applied in preference to the overall framework given by Ind AS 1. This is an interesting point which you have to keep it in your mind. Similarly, when you are talking about an IFRS financial statement, what is the difference between IFRS and Ind AS 1? IFRS gives you only overall guidance. There is no prescribed format under IFRS. Reason is there is no Schedule 3 to the Companies Act. Like that, no separate entities or separate countries, company law has prescribed any format. Okay. So accordingly, under IFRS, there is no specific format. Under Ind AS 1 also, there is no specific format. But in India, we will apply the principles based on Schedule 3 to the Companies Act, which has to be mandatorily followed. Okay. So now, let us understand what the balance sheet is talking about. So, if you are talking about one question which somebody from Chennai has asked, it says that you can give in the order of liquidity also if it presents more the relevant than current and non-current. But if you see, this is because such entity does not supply goods and services within a clearly identifiable operating cycle. You will see what is operating cycle later on. If an entity is not supplying goods or services, for example, if it is an NBFC, non-banking financial services company, I am not supplying any goods, I am not supplying any services which is in an operating cycle. Okay. So in that type of industry, other than NBFC, and accordingly Schedule 3 format of current and non-current has to be applied. When you are doing for a NBFC, there is Division 3 which is prescribed, and there is a format prescribed by Division 3 of Schedule 3 which follows the liquidity basis of accounting. So if it is an NBFC, you use liquidity basis. If it is a non-NBFC, you will use non-current current classification. That is what Schedule 3 is requiring to do it. Now, we were talking about operating cycle. Let me put you what is operating cycle is. Very, very simple. Don't get confused. Operating cycle is cash to cash cycle. You might have already read that as part of your SFM, or you might have read it as part of your costing in the previous portion of your learning curve. You might have seen it. What is operating cycle is nothing but cash to cash conversion. What do you mean by cash to cash conversion? I have cash, with that I purchase raw material. Raw material has to be processed into WIP, work in progress, and work in progress has to be converted into finished goods. Finished goods is sold to the customer. Customer collection period takes some period, say 90 days. And after that, I collect the money from the customer. It comes back as cash. So whatever is cash to cash cycle. So for example, raw material has to be in process. The cash to raw material procurement will take, say for example, 2 months. And the raw material process to WIP will take 15 days. And another 15 days is required to convert WIP into finished product. And data will be collected in 3 months time. What happens? Cash to raw material 3 months plus half a month for WIP, half a month for finished goods, another 3 months for my collection back into cash. So 3 plus half plus 3. That is 7 months is considered as an operating cycle. In any example which they are giving, if they are giving that this is the collection period, this is the period with which you will settle this, add up all the periods, then you will identify what is your operating cycle. Why the operating cycle is important is that if anything is expected to be collected within the operating cycle, they are considered to be current asset. Anything to be settled within the operating cycle, that is considered as a current liability. Only for determining that we are talking about operating cycle. But I have seen that many questions in the past examination for final is coming around operating cycle. So we will take 1 or 2 examples to understand the operating cycle also. What happens is, this is from acquiring the asset for processing and realization in cash or cash equivalent. What is the process? What is the time which you are taking in between? From cash to cash, what is there? The time in between is considered as your operating cycle. Suppose if you are not able to say, sir, I don't know how much time it will be requiring to convert a particular item, or my lead time to place an order and get the raw material. I am not very sure. It varies depending upon the market conditions. So if you are saying that it is not clearly identifiable, for example, one particular cycle is not able to be identified. In our example, we are saying that raw material procurement cycle, I don't know what is the exact period. So in that case, you cannot determine what is the exact operating cycle. If it is not clearly identifiable, please understand, when it is not clearly identifiable, it's 12 months. So operating cycle will be considered as 12 months. In case if you are not able to clearly identify the operating cycle. Another question which may come, I will take an illustration, then you will understand this. For the illustration, I will go to a Word file. In case the Word file, I am changing the sharing. So in case the sharing is not going to be visible, you tell me. As of now, I will just explain and then I will go to the file. There could be a situation that the entity may be having more than one product or more than one vertical. For example, I can take an example of a company is in a manufacturing sector also for a particular automotive components, and it also kind of does some maintenance services like a workshop type of thing for the auto, for the car or for any two-wheeler. So just I'm giving, one is relating to manufacturing and selling of cars. Another is servicing of cars by means of a workshop, right? The operating cycle for manufacturing will be different and for servicing may be different, because in servicing, you will be able to quickly convert that into cash and cash equivalent. Whereas here, right from raw material, WIP, finished product, debtors, and then collection. Whereas in services, you procure all the materials for services is one aspect. Providing the services, debtors, collection period is another services. But in majority of the cases where we are going for a service industry, the debtors are collected on the day where the delivery is happening. So if, for example, if the repair period is only 2 days, the collection period is also only 2 days. And accordingly, there could be a possibility for the same entity which has manufacturing of car and servicing of the cars will have two different operating cycle. In that particular situation, the current and non-current classification will be dependent based on to which vertical it belongs. For example, debtors relating to service industry will be defined as current asset or non-current asset based on that particular operating cycle. Debtors relating to sale of car will be determined based on the operating cycle relating to cars, right? So different vertical within the company or within the entity may have different operating cycle. So one entity may have more than one operating cycle also, and to that extent the assets and liability relating to that particular cycle has to be identified, and you have to apply the principles of current and non-current classification. We will go to the current and non-current classification a little later. To understand this, I'm just going to share one Word file which is containing certain examples. Sorry. You must be able to see this particular Word file, if I'm not wrong. You are able to see that, right? Okay. So we are taking the example illustration 5. In illustration 5, what we are saying is raw material stock holding period is 3 months, work in progress holding period is 1 month, the conversion period, and finished holding period. Even after I have converted, I'm not able to sell it, so I have to hold it minimum stock, that is 5 months. Debtors collection period is 5 months. You are required to compute the operating cycle of X Limited. As I have said, cash to cash cycle should be operating cycle. In this case, raw material requires 3 months, work in progress requires 1 month, finished goods requires 5 months, and debtors requires 5 months. So what should be the collection period? 3 plus 1 plus 10 plus, 5 plus 5. So this will be 14 months is the operating cycle for this particular entity. Okay, that is what we are calling as your operating cycle. So very simple. What is the total period you are supposed to have your raw material from cash? It is sitting in raw material stage for some period. That is added, that is 3 months. Work in progress converted, but it has to be there in work in progress before it get converted into finished goods 1 year, 1 month, 1 month. And finished goods holding period, even if I have converted into finished goods, that cycle is also required, but I have to hold it also minimum stock, that is 5 months. And debtors after sales will also get collected only after 5 months. So all this put together, it's what we call it as a operating cycle, normal operating cycle. Why this normal operating cycle is required is because we will have current and non-current classification. Now I'm going back to our PPT. That is what I have said, acquiring of the asset for the purposes of processing and holding, and when it is getting realized in cash. So from the moment I purchase a raw material to convert that into my cash again is the total period which you have to consider. Now you have seen that in our example we have put 14 months as the operating cycle. In some cases what may happen is it requires only 1 month raw material stock, 1 month finished product, 1 month WIP and 3 months of debtors. So 3 plus 1 plus 1 plus 2. So 6, 7 months will be what you will consider as your operating cycle. What is the requirement of this operating cycle? Operating cycle will be used for determining the current and non-current classification. If you see Ind AS 1 comes with 4 conditions to decide any asset as current asset or non-current asset. Similarly, there are 4 conditions which has been given to decide whether a liability will be current liability or a non-current liability. Even it is all the 4 conditions for current asset or 4 conditions for current liability are not cumulative condition. What does that mean? Even if one condition out of 4 conditions has been met, that item will be treated as current. If all the conditions are not met, it will be treated as a non-current. Okay, that is what important. So what I am trying to make it is that in case if we wanted to show that as part of our understanding, a picture will communicate better than a text. That's the reason why I converted that into a flow chart. If you see the standard flow chart is not there, it only talks about 4 conditions. But for our understanding, we are converting that into a flow chart for a simple reason. Flow chart will make a concept. Okay. Now, what is the first condition? The first condition says whether it is expected to be realized, sold or consumed within the normal operating cycle. If I say yes, it is expected to be realized, sold or consumed within the normal operating cycle, it becomes a current asset. Let us take one example. Debtors are expected to be realized in cash back. If my operating cycle in the example which we have seen is 14 months and your debtors outstanding is expected to be realized within 14 months, don't look into the credit period. Credit period is 9 months in the example which we have took, in the example we have took 5 months in the Word file which we have seen, which I also shared with you. We took 5 months for the debtors collection. So if anything more than 5 months, don't consider that it's a non-current asset in respect of debtors. What it says is that expected to be realized within the normal operating cycle. So normal operating cycle is 14 months. If you expect your debtors will be realized within 14 months from the end of the reporting period, you can still hold that debtor as part of your current asset. Expected to realized is normally debtors. Sold. I have traded goods. I have finished goods, which is expected to be sold within next 12 months or next 14 months, because our operating cycle in that case is 14 months. So 14 months, if I am expecting to sell my finished goods, to that extent, it is happening within the normal operating cycle. Still, it will be a current asset. What will happen? Suppose if I have a finished goods, and I'm saying that the operating cycle is, we assume that different operating cycle, 6 months is operating cycle, and the finished goods are expected to be sold only in 10 months time, not in 6 months time. Whether I have to consider that particular item as a non-current or current, we will hold it for a moment. After we are seeing all this, we will get into all the complex situation. Expected to be sold within the normal operating cycle is a current asset. Expected to be consumed within the normal operating cycle, it is also considered as a current asset. What is expected to be consumed? Your raw material, your stores and spares, your WIP, it is all getting consumed within the normal operating cycle to convert that into a collectible cash position. So whenever we are talking about expected to be realized, sold or consumed within the normal operating cycle, in our example we took 14 months. If it is expected to be realized within 14 months, sold within 14 months or consumed within the 14 months, it is considered as a current asset. Now, if I am saying no, it is not expected to be collected within 14 months. What I am supposed to do? I will go to ask the next condition, whether it is fulfilled. Is it held for sale? If I am saying yes, it is held for sale, it is considered always as a current asset. Let us go back to an example. In this example, we are taking the same 14 months of operating cycle, where the collection period of debtors is 5 months and the finished goods is 5 months holding period. Let us see. The management expects that the finished goods stock will be sold, will not be able to sold within the reporting period. It will sell it only after 2 years. We are taking that as an example. Finished goods, they are saying market has crashed, and because of that, entire finished goods cannot be sold within 14 months of operating cycle. It will be sold only within 2 years. That means some portion will be sold after 14 months. The question is, if I am testing the first condition, expect it to be sold within the normal operating cycle? No, because 14 months is not happening. So it cannot be a current asset. But the second condition is it held for sale? Inventory is always held for sale, and accordingly, even if it is not expected to be sold or consumed within the normal operating cycle, still because it fulfills the second condition, it is held for sale, it is always current asset. It applies to raw material, WIP, finished products. In everywhere, inventory is always held for sale, right? So accordingly, it is considered as part of your current asset. Let us put the same example to our debtors. We said operating cycle is 14 months, collection period is 5 months. Assuming that the debtor has a problem, and because of that I am expecting only after 24 months it will be collected. What will happen? Expected to be realized, sold or consumed within the normal operating cycle is not going to happen. Normal operating cycle is 14 months, but the expected realization is 24 months. So that is not the condition. First condition is not met. What is the second condition? Is it held for sale? Whether trade receivable is held for sale? No. Accordingly, second condition also fails for a trade receivable. In that particular situation, we have to move on to the third condition. What is the third condition, which says whether it is expected to be realized within 12 months from the end of the reporting period? In our example, operating cycle itself 14 months. Why should I worry about 12 months? Even in 14 months, it is not going to be realized. And necessarily 12 months also it is not going to be realized. It is going to be realized only after 24 months. And accordingly, third condition also not matched with the trade receivable. If it is matched, in our example, it's not matching. If it is to be collected expected to be collected within 12 months, it will be current asset. If I'm saying no, then the last question which they are asking is it unrestricted cash and cash equivalent? There is no restriction in getting the cash and using the cash. And if it is cash and cash equivalent goes with India's 7 definition: cash, bank deposit having original maturity of 3 months, any other short-term investment which can be realized without any loss of face value, immediately realizable investments, those are considered as cash and cash equivalent. A trade receivable in our example is not a cash and cash equivalent. Accordingly, the fourth condition is also not satisfied. If it is a cash and cash equivalent, it becomes a current asset. If I am saying the fourth condition is not also fulfilled, that particular asset will be considered as a non-current asset. Right? You are very clear now. Trade receivable, where the operating cycle is 14 months, not expected to be collected within 14 months, will become a non-current asset. So on that basis, you can put any number into the flow, any item into the flowchart, you will get an answer for this. For example, property, plant and equipment. I have a machinery. Whether expected to be realized, sold, consumed within normal operating cycle? No. I am going to use it for production purposes or administrative purposes. So first condition is not satisfied. Is the machinery has been purchased for selling purposes? No. In that case, it becomes an inventory. But whereas I am going to use it in my normal process, this process, manufacturing process. So it is also not held for sale. Whether it is expected to be realized within 12 months, I am not going to sell it. Machinery is going to be with me for the economic useful life of the asset. So the third condition is also not satisfied. Fourth condition, is it cash and cash equivalent? No. Accordingly, property, plant and equipment becomes a non-current asset. So anything you can put it. For example, if I am talking about an investment, right? Investment expected to be realized, sold, consumed within the normal operating cycle. It is not a debtor. It is not my raw material. It is not my WIP. It is not my finished product. And accordingly, operating cycle itself is not relevant for investment. Accordingly, it is not required. Investment, is it held for sale? Regularly you are buying and selling, or you are just invest and kept it. So assuming that I am investing for the purposes of earning the interest and principal arising out of it, it is not held for sale. The third condition is, are you expecting to sell it within the next 12 months from the end of the reporting period? 31st March 2020 is my end of the reporting period. Are you expecting to sell before 31st March 2021? In that case, it will become a current asset. Assuming that no, I am going to keep it till the redemption date, which is going to come in 2025. Then not expected to be realized within 12 months. It is not cash and cash equivalent. Then in that case, that investment will become a non-current investment. Suppose if we say that I am regularly buying and selling the investment, it's a current investment. Then automatically it comes to current asset. Suppose if I am saying no, not regularly buying and selling, but maturity period is within the next 12 months. I am going to collect it within the next 12 months. It meets the criteria of third one, becomes a current asset, right? This is an important point which you have to keep it in your mind. Based on this, we are going to see 3 illustrations to understand how the assets will be classified into current and non-current. I am stopping this PPT presentation and I am going to open the Word file, and then I will share the Word file on your screen so that you will be able to see the Word file to understand the illustration. Let us take that illustration. Inventory, of course, or trade receivable is normally realized within 15 months in respect of X Limited. So they are talking about the receivable period. How should X Limited classify inventory or trade receivable as current or non-current if they are expected to be realized within 15 months? So when you are saying expected to be realized, normally realized is normal operating cycle, right? So when you say normal operating cycle itself is 15 months, normally expected to collect it in cash is 15 cycle. Normally realized is normal operating cycle. And this inventory and trade receivables are expected to be realized within 15 months. If it is going to be collected, expected to be realized, debtor is expected to be realized within 15 months. Inventory is going to be sold and realized within 15 months. In that particular situation, both inventory and trade receivable will be considered as a current asset. Okay. Normally realized means it's a normal operating cycle. Sometimes words will be used to confuse you. Normally realization is that nothing but your normal operating cycle. If you have a doubt whether that is that case, you write first sentence itself. It is normally realized in 15 months, and normal operating cycle is not specifically indicated, and accordingly it is assumed that the normal operating cycle is 15 months. On that basis, as per Ind AS 1, if the debtors or inventories are realizable within the operating cycle, then it should be considered as current asset. In this example, it is expected to be collected within the normal operating cycle, so it will be treated as current. Okay, depending upon the number of marks, whatever you wanted to explain. And we take another example. In this case, this company produces aircraft, that is, it's manufacturing aircrafts, right? So normally manufacturing aircraft cannot happen within a short period. It takes normally a different period. What it says is the length of the time between the first purchase of raw material and the date the company completes the production and delivery is 9 months. So that means from raw material to finished goods delivery, it takes 9 months. That is the first cycle. Raw material, WIP is finished goods, is given as 9 months. Company receives payment for the aircraft 7 months. That means the debtors holding period is normally considered as 7 months. So what we have seen, the raw material holding period, WIP holding period, finished goods holding period, debtors holding period, all put together is what we called as a operating cycle. The question is, what is the length of the operating cycle? Definitely it is 9 plus 7 months, 16 months. Okay. Okay. How you have to treat the inventory and debtors? So when I am saying that if the debtors are collected within 16 months, it will be treated as current. If the inventory will be realized within 16 months, it will be consumed or it will be sold, then it will be considered as current asset based on the first classification. Suppose if I am saying, no, inventory may take more than 16 months in this example, first condition is not satisfied, but the second condition, is it held for sale, will always be met. So accordingly, inventory will always be considered as current, even if they are saying more than 16 months in respect of inventory, and debtors we have to consider because it is more than 6 months. First condition not satisfied, second condition not satisfied, it is not held for sale. Third condition, expected to be realized within 12 months, not satisfied. And finally, we are also talking about a case where we are talking about a scenario of what we call is it cash and cash equivalent? That is also not there, right? Debtors may pass if it is more than 6 months realization. But in this question, they have said that expected to be realized within 16 months. Because of that, both inventory and debtors will be considered as part of your current asset. I take one more example. In this case, entity manufactures passenger vehicles. Time between debtor purchasing the raw material, manufacturing and delivery is 11 months. Customer settlement is 8 months. So your inventory holding period, raw material, WIP and finished products is 11 months, and your customer collection period is another 8 months. So the normal operating cycle is holding period of raw material, holding period of WIP, holding period of finished goods, and collection period of debtors, cash to cash cycle. So in our example, it is 11 months plus 19 months is the operating cycle. So will the inventory and trade receivable will be the current in nature? Yes, they will be current in nature, provided they are expected to be realized in the normal operating cycle. For example, if I am saying debtors will also be collected within 19 months, it's a current asset. Inventory anyway will be consumed in the operating cycle, it is current asset. Even if the first condition is not satisfied, for inventory we have said, the condition is held for sale. Because held for sale will be met for inventory, you will have inventory always as a current asset. Based on the operating cycle, debtors as such, if it is expected to be realized within 19 months, it is considered as current asset. If it is expected beyond 19 months, it will become a non-current asset. A portion of the debtor which is expected to be received after 12 months will be considered as a non-current. The second question is, assuming that the production time was say 15 months and the time lag between sale and collection period of customers is 13 months, will the answer will be different? 15 plus 13, it becomes 28 months, right? Even if it is 28 months, you can still apply the same principle for your inventory, whether your inventory will be collected within 28 months or realized within 12 months. Then it becomes a current asset. Because even if it is not matching the first condition, in this example we are saying that it is the period they have given itself is 28 months. For 28 months being the operating cycle, I will apply 28 months to determine whether inventory, debtor or credit, the raw material, finished product, WIP is current asset. Assuming that, yes, everything will be collected within 28 months, even for debtors. Debtor becomes current asset. Inventory also within 28 months I will consume that. That is also becoming a current asset. Assuming that the debtor is not expected to be collected within 28 months, it will take 3 years for collection. In that case, the portion of the debtor which is going beyond 28 months has to be checked with the other conditions. Other condition is it held for sale? No. Other condition is it expected to be realized within 12 months from the end of the reporting period? No. Is it cash and cash equivalent? No. All the 4 conditions are not satisfied. That portion of debtor which is expected to realize after the operating cycle, which is more than 12 months here in this example, is considered as a non-current asset. That's what I'm showing this. Inventory shall be treated always as current, even in the first case or in the second case, because second condition anyway will be met. But debtors will be classified as current only if it is expected to be realized within the operating cycle. In this case, the operating cycle is going to be 28 months, right? So this is what you have to consider for the purposes of your determination. Okay, now we will come back to our PPT because your operating cycle discussion is over. Now we will decide whether we have something like the PPT is now visible to you on the screen. Right. Sorry, I will share it again. Okay, we have seen the decision tree and we have understood for current asset. And a lot of examples which we can talk about. In this case, we are talking about a case of entity which is having production of whiskey, right? Normally, the inventory itself will take a lot of time. 24 months is a distillation period. At the end of the reporting period, entity has 1 month supply of barley and yeast raw material and 800 barrels of partly distilled whiskey, and how it has to be classified. As I have said, it is an inventory. Inventory is expected within the realized or consumed within the operating cycle. So it is normally considered as a current asset. Suppose in this example, they have given it's a 24 months, but they are saying only 1 month stock is available. So naturally within the operating cycle. Suppose if they are saying the inventory is outstanding for more than 36 months, in that case also it becomes a current asset because first condition not satisfied, but the second condition is satisfied, held for sale. So accordingly, that is also considered as a normal operating cycle. There is a machinery which is used for manufacturing of goods, also owns a building which is carries out for its commercial activity. One is machinery used in production and another is used for its commercial activity, that is administrative purposes. What will happen for the plant and machinery and the particular item of building? Go back to the decision tree. Whether it is expected to be realized within the operating cycle? No, because I am not realizing anything, I am going to use it. Is it held for sale? No. In both the cases, they are saying manufacturing goods for sale, but not the machinery itself for sale. Similarly, the building is used for commercial activities, not for sale. So second condition not met. Third condition is whether this particular machinery or building will be sold within next 12 months and realized. No information is available on that. So third condition is also not fulfilled. Whether machinery and the building is cash and cash equivalent? No. Accordingly, all the 4 conditions are not satisfied. Then the machine and the building are considered as a non-current asset. Now you are very clear why we are having that flow chart for you to easily understand. At no point of time you should have When you are sitting on the examination, there is a question on current and non-current classification. Just to recollect that particular flow chart, you will have your answers very, very clearly. Okay. Now, let us move on to certain other examples. In this example, we are saying that an entity replaced a machinery in its production line. The replaced machinery was sold to a competitor for 3 lakh. Payment is due within 15 months after the end of the reporting period. Whether it will be considered as part of current asset or non-current asset. So what now happens is it is already sold that machinery, right? It is sitting as a debtor for capital goods. Payment is expected to be realized within 15 months. The operating cycle, when it is not given what we have said, should be identifiable, you should always consider as 12 months. So it is not expected to be realized within 12 months. First condition not satisfied. It is a receivable. So to that extent, whether it is considered to be held for sale, no. Third condition is whether it is expected to be realized within 12 months from the end of the reporting period. We are saying no, right? Because of that, last condition anyway will not satisfy, cash and cash equivalent. So to that extent, that becomes a non-current asset, right? Clear now? Anything which is given in the example or anything which is tested for you in your examination, you can simply use this flowchart and you can find your answers. And next, one more example I am trying to take. What is the one more example? I have invested 15 lakhs of corporate bonds that bear interest at 8% per annum. Interest payable on the corporate bonds is on April 1st of each year. The principal is repayable in 3 annual installments of 5 lakhs starting from 1st April 2013. Here little bit of difference is coming in. It is not having only one maturity date, and accordingly I cannot simply put that number in a single classification. I have to identify what are all the things which will be happening. Please recollect what I was saying. That portion of the trade receivable which is expected to be realized within 12 months will be considered as non-current, and what is beyond 12 months, I said that it will be considered as non-current. That portion, that means a same asset or same class of asset can have both current classification as well as non-current classification. Only exception is inventory, because inventory is always held for sale. All other things may have both current classification as well as non-current classification. And of course, there is one more exception is there. Deferred tax asset and deferred tax liabilities are always considered as non-current. That is because of Ind AS 12 on deferred taxes on income. So 2 exceptions. Inventory is always treated as current. And another exception is deferred tax asset and deferred tax liability always considered as part of your non-current asset or non-current liability. That's the only 2 exception. Apart from that, everything has to be assessed based on expected to be realized within the operating cycle, held for sale, expected to realize within 12 months from the end of the reporting period, or cash and cash equivalent. Now we come into this. What happens here? Investment has been made, 15 lakhs has been made. It bears interest of 8%, but the interest is not payable on 31st March. It is accruing only on 1st of next month, that is April. So interest accrued on the bond is also an asset. On accrual basis you will do, but it is expected to be realized within 12 months from the end of the reporting period. That becomes a current asset. Interest accrued on the corporate bonds is expected to be realized within next 12 months from the end of the reporting period. So it is a current asset. So the 8% on 15 lakhs or whatever outstanding amount, you will collect it. And what it says is that the principal is repayable in 3 annual installments starting from 2013. 1st April 2013. So our year end is what? 1st April 2012 means 2013 is March 2013 is the year end. First repayment starts immediately next year. So one repayment might be happening within 2014 March, right? So 5 lakh is the amount which is expected to be realized within next 12 months from the end of the reporting period. End of the reporting period is expected to be realized on 1st April 2013, within 12 months from the end of the reporting period. So 5 lakh will also be shown as current asset. Balance 10 lakhs will be shown as non-current asset. Interest accrued, because it's going to be realized on 1st April, it will also be current asset. That's what I'm saying. The 1,20,000 of accrued interest, which is 8% on 15 lakhs, will be treated as current asset. 5 lakh, which is expected to be realized in the next 12 months, will also be treated as current asset, and balance 10 lakhs will be treated as non-current asset. Okay. Now, we have seen on current assets. Now we have to see on current liability. What is the change? Here also the 4 conditions are there. Only thing is, there we are talking about expected to be realized. Here, can I say that liability will be realized? No, liability will always be settled. So only change is the wording which has been used. And another important thing is, expected to be realized is what we are saying. Expected realization, I have an asset. When I am expected to realize that asset, that's what we are looking into. Here what we are saying is, I cannot decide when I will settle it. Based on the terms and conditions agreed with the other party, my supplier, or the party from whom I have taken a loan, whether the entity is, what is the due date, when it is due to be settled. So that is the 2 points which we say. One is, what is the settlement date instead of realization date? What is the due for settlement instead of expected to be settled? 2 changes are brought in. And of course, there is one condition which we are going to say, cash and cash equivalent cannot be liability, and to that extent, that is replaced with a new condition. You may ask, sir, why you are confusing me with saying comparing with the current asset? I always believe that sometimes we forget about the conditions relating to something else, but we know the conditions relating to asset. But when you are having a connected reading, you will understand that, oh, on the date, we have told that it is not expected to be realized. It is based on due to be settled. Oh, due to be settled is the 3rd condition. Cash and cash equivalent cannot be for liability. It should be some other condition, which we will see. So that's a connected reading will always help you to remember and be very clear on your concept. That's the reason why I am using it. For example, here, whether it is expected to be settled within the normal operating cycle. If I say yes, it's a current liability. It's not current asset. It's a error. It's a copy paste of situations. When you prepare one slide in one format and changing it to another format, this is current liability, because we are talking about current liability decision tree. Is it held for sale? Whether the liability is held for sale. Is it possible a liability can be held for sale? There is one standard called Ind AS 105, non-current asset held for sale and disposal groups. For example, I wanted to sell off one particular vertical which is manufacturing, say, beverages. It contains assets as well as some liabilities. For example, it contains a bank loan. It contains a creditor. When somebody wants to buy it, I'm saying that you buy it as a bundle, both assets as well as liability. So to that extent, the liability is also held for sale. Only in 105 it will happen. In that case, it is a current liability. Okay. Suppose if I am saying, no, it is not held for sale. It is not expected to be realized within the operating, expected to be settled within the operating cycle. What is the 3rd condition? The 3rd condition says whether it is due to be settled within 12 months from the end of the reporting period. So that means period. But I am going to settle it after 2 years because I have a dispute. But whether it is a due to be settled, yes, it is already due to be settled. And to that extent, the trade payable based on the terms and conditions with the custom supplier, I have to treat that as a current liability. Due to be settled is different. Expected to be settled is different. In asset, they have used the word expected to be realized. Whereas in liability, they are using the word due to be settled. That means what is the due date according to the terms and conditions of the contract with the supplier. Maybe what is the terms and conditions with your lenders, based on which you have to decide if it is due to be settled within 12 months from the end of the reporting period, it should be considered as part of your current liability. Suppose if I am saying no, it is also not expected to be settled within, due to be settled within 12 months. whether you have an unconditional right to defer the settlement beyond 12 months. Whether you have an unconditional right to defer settlement, meaning what? Next 12 months, the lender cannot ask me any repayment. The creditor cannot ask me any repayment. There is a dispute in arbitration. The other party cannot ask me any payment. I have an unconditional right. I have an unilateral right to defer the settlement beyond 12 months. What will happen in case of litigation? If the litigation gets completed within 12 months, I don't have an unconditional right to defer. And I am also not sure whether the litigation will get settled within 12 months. I am not clear about that. It's an uncertain situation. Accordingly, there is no unilateral control which is available to me to defer the settlement beyond 12 months. Okay. So in that particular situation, if I do not have that condition, it becomes a non-current liability. If I have an unconditional right to defer if I have an unconditional right to defer settlement, it becomes a non-current liability. If I does not have an unconditional right to defer settlement, it is a mutual agreement. Then in that case, it becomes a current liability. In all other cases, it becomes a non-current liability. This is an error. Please correct this, because I expected that this error will also be there, because it's a copy paste of the previous decision tree. All the conditions have been changed, but the last one is not changed. Okay. It's a non-current liability. Let us take one example. I have a trade payable. The trade payable is expected to be due to be settled based on the terms and conditions which I have agreed. Is it a normal operating cycle? When I am talking about inventory holding period, the credit given by the creditors is also assumed. Okay. So market credit, if I am taking the 15 days, that 15 days is also taken into consideration. So it falls under normal operating cycle. Whether it is due to be settled within the normal operating cycle, it becomes a current liability. Is it held for sale? No. Whether it is due to be settled within 12 months, because my contract period is only 9 months or maybe 6 months is the due date. So within the due date, whether that 6 months is within next 12 months, yes, current liability. Suppose if it is due to be settled beyond 12 months, normally trade creditors will not be a situation, but bank loan could be a situation. So there the trade payable becomes settled here. Let us take another example. I took a term loan from a bank, which is repayable on 5 years with 1 year holiday period for repayment of principal. So what happens? Is it expected to be due to be settled within the normal operating cycle? No. Is it held for sale? No. Whether due to be settled with 1 year holiday period is there, so no repayment is happening. That is also not fulfilled. Then the next condition is whether the company has an unconditional right to defer settlement beyond 12 months. Yes, as per the terms and conditions, 5 years is the repayment period. First 1 year is a moratorium. Accordingly, I have an unconditional right to defer settlement beyond 12 months. Okay. So if I have taken a loan and I am having 1 year of moratorium, we have to test what is the date on which the loan has been taken. For example, if I have taken the loan on 1st of April 2019 and we are preparing the financial statement for 31/3/2020. 1 year holiday period ends on what date? By 31/3/2020. The moment it is over, I have to repay the first installment within 12 months from the end of the reporting period. I do not have an unconditional right to defer beyond 12 months because the 12 months period is already, holiday period is already over. So you have to be particularly careful what is the date on which the loan has been taken. In our example, when I am saying 1 year of holiday period, even if I have taken on 31st March, it falls due within the next 31st March, right? So accordingly, that portion, 1 year repayment portion, whatever we have seen in the previous example for investment, which is going to be realized 5 lakhs in the beginning. If the term loan is, say, for example, 20 lakhs, and I am going to repay in 4 annual installments starting from 1 year after the date of loan. That date of loan is, say, for example, is 31st March 2020. First installment falls due on 30th of March 2021. So in that case, we have to be careful that which is due to be settled is 12 months from the end of the reporting period. And accordingly, I do not have any unconditional right to defer settlement. Both the conditions will fail. So that 1 year period is considered as current maturities of non-current liability. That will be shown separately as a current liability. The balance 3 installment will be shown as part of non-current liability relating to the term loan. Suppose in our example, I took a loan on 31st March 2020. Holiday period is 2 years. In that case, nothing is falling due within 12 months from the end of the reporting period. It is due only on 30th March 2022. And accordingly, the third condition itself is not fulfilled. And I am going to the fourth condition. Whether I have an unconditional right to defer settlement? Yes, I have the right to defer settlement beyond 12 months from the end of the reporting period, because the holiday period is 2 years. So in that case, the entire term loan will be treated as non-current liability in the first year. When it comes to 2021, what happens? One installment due in 2022. That portion will be treated as current maturities of long-term debt, and the balance will be shown as non-current liability. I think you must be clear on this as well. The important point which I wanted to tell you is that expected to be settled is not applicable. Due to be settled is applicable. That is where there could be a different scenarios. I think I have one question. If that question is not there, I will take into consideration. There are some questions which I am taking into consideration. How you will determine the asset classification? We should understand the client's business based on which asset classification will come in. I have machinery in my balance sheet. Can I straight away take the machinery as non-current asset? Not possible, because I have to understand what is the client's business. If the client is manufacturing machinery and selling the machinery, if I am talking about that particular machinery in the business of the client, it becomes inventory for them, right? Inventory is held for sale. It becomes a current asset. Suppose if I have purchased a property plant machinery and that machinery is going to be used for production, in that case it becomes a non-current asset. So you have to be particularly careful about what is the client's business, whether it will be treated as an inventory or it will be treated as non-current asset. You have to take a call. Management, we are saying no, due to be realized. Who will decide when it is expected to be realized? That expected realization is based on the intention of the management. You have to be clear that the intention of the management decides expected to be realized. Expected to be realized is coming from the management expectation. But having said that, if the management says all my 3 years old debtors will be collected within the next 12 months, it should be demonstrated with evidence. So we normally look for on what basis you are saying that it's possible. And normally as an auditor, we will perform some audit procedure whether we can rely on what the management says as collectible. Okay, we will normally apply that principle as well. And expected to be realized, who has to be determined? It is from the point of view of the management. Auditors cannot say, no, sir, I wanted to decide what is the expected date of realization. You don't have any role. You can only ask them to prove you have an expectation to realize this particular debtor. How it is going to happen? 2 years it is not collected. How you are going to happen? Maybe they have entered into an agreement by means of discounting that with another party or something like this. Some evidence or some negotiation might have come in. That should be demonstrated. Okay, this is something additionally you have to understand. This is an interesting question. We have talked about a comparative with respect to current and non-current classification. Assuming that I am having a particular asset as a non-current asset in the previous year. I have a machinery which is being used for my production purposes. So naturally all the 4 conditions relating to current asset is failed. So I shown that as a non-current asset. In the current year, I have decided to close down that particular vertical of the business. So accordingly, I have classified that particular item non-current asset held for sale as per Ind AS 105. Okay. So Ind AS 105 says if there is a non-current asset which is held for sale, that should always be classified as a current asset. Okay. So the question comes is, last year it was shown as part of property, plant and equipment as a non-current asset. This year you are going to say that it's a non-current asset held for sale as a current asset. Comparatively, for the non-current asset held for sale, previous year number will be nil. And for previous year's property, plant and equipment, there will be a sudden fall in the current year number. Whether I have to restate my comparatives also, that means whatever is the asset now classified as non-current asset held for sale, whether I have to reclassify them as part of my current asset in the current year, in the previous year also. From non-current asset, I have to no, because based on the facts and circumstances existing as on the reporting date, current and non-current classifications will be done. Based on your assessment of the 4 conditions, you will decide whether it's a current asset or non-current asset. Last year, the facts and circumstances said that it is a non-current asset. This year, it has said that it is not a non-current asset. So accordingly, today's circumstances is different from previous year's circumstances. You should not restate. Only one exception to this rule is that previous year, there is an error in comparative number. For example, I am supposed to show a term loan as part of current liability, but a portion of that as a current liability, but I have shown the entire term loan as part of non-current liability. This year, I am correcting that by putting current maturities of non-current liability, I am putting in the current period. Whether the previous year figures has to be restated, both in the current liability where I am showing current maturities of long-term debt, as well as my term loan which is shown as non-current liability. Yes, because there is an error in the classification in the previous year. You remember that we have done that as 3 circumstances where we will give a third balance sheet. One of the circumstances we have said that there is a restatement of the previous year number because there was an error in classification. That also requires a restatement, right? Only if there is an error, current year number and the previous year number will be restated. In all other circumstances, just because one item is moving from non-current to current, you will not restate your comparatives. Only error condition, you have to change it because that error condition is covered by Ind AS 8. Now, what do you mean by held for sale? I'm saying that this asset is held for sale. This item is held for sale. Is it any time limit which has been prescribed? The standard says that held for sale means it is highly probable that it will be sold. For example, if I am saying that there is a machinery which I have now going to dispose it of, I have moved from non-current classification to current asset, non-current asset held for sale and showing that as part of my current asset. But held for sale, within which period I have to see? 5 years I am continuing to show that as non-current asset held for sale. Is it correct? Ind AS 105 says that held for sale should be highly probable that the sale should be completed in the next 12 months. Otherwise it is not held for sale. So normally the 12 months period is implied to be considered with respect to this non-current asset held for sale. All other circumstances, you have to actually see what is the relevant. For example, inventory. When I am saying it is held for sale and I am able to sell it within the next 12 months or 36 months, 48 months, still it is considered as held for sale according to the condition. 105 alone says that held for sale, it should be highly probable that the sale must be capable within 12 months. So you have to be a little cautious on that. This non-current asset where there is a breach of terms and conditions for term loan, whether it should be considered as a non-current liability or current liability, we have already discussed that as one of the carve-out in the previous session. I also have one example which we will discuss little later, where you will have a clarity of how it has to be discussed. For the time being, I am just parking it. And interestingly, another question, classification as current in the financial statement of the standalone financial statement of the entity. When consolidated financial statement happens, whether it remaining to be non-current asset or not. So that also we have to see from the perspective of what we have said. Current and non-current classification should be tested from the perspective of the entity which is preparing the financial statement. When I am saying that standalone financial statements are prepared, from the standalone perspective, I have to see what is the realization within 12 months or not. When it is a consolidated, I have to consider whether this is expected to be realized from the consolidated perspective, group's perspective itself, whether it's a current or non-current. We will take some examples on that. I have some examples from example 9 to 17, but we have already came to 8:30. What I will suggest is that we will take a short break of 5 minutes and we will come back where we will discuss all the illustrations of 9 to 17. And these illustrations, somebody has repeatedly asked my question, whether these questions are in line with the study material. Yes, exactly in line with the study material, because you are expected to read the institute materials more and more. And accordingly, I am also taking the illustrations only from the study material's point of view. Okay, whatever I am discussing is also from the point of view of the study material. We will take 5 minutes break and then we will come back and discuss that illustrations 9 to 17. Word file which we will discuss. Let me answer the questions which has been raised by you during the first session so that we can close out the first thing. Some of the questions are still coming with respect to the day one discussion, but anyway, as a recap, I will do that. Does any changes in IFRS after the convergence can be treated as amendment in Ind AS? What happens is that if there is a change which has happened subsequent to convergence happened in say 2014, what we are trying to do is that we are amending our standard itself by means of a limited revision or maybe as a complete new standard. For example, we have issued a new standard on revenue from contract with customers. Ind AS 115 has been newly issued. We have also issued another standard called Ind AS 116, where we have issued that particular standard for leases. So wherever there is an amendment which is coming in IFRS, we are actually doing the convergence here also. And to that extent, the convergence process will continue till such time we are doing it. So that will be part of the convergence itself. The same question has been repeated again by Anil. Maybe he has felt that I have not done it. In case of conflict between Companies Act Schedule 3, I have already answered that because Companies Act will prevail over the accounting standard. What is given in the accounting standard in the Companies Act will be taking an upper hand. So you have to go with the respect of that particular situation. Departure from requirement of Ind AS was pending. Aruna, I think that I was having a slide. Maybe we have missed it also. I will explain what Aruna is mentioning from Pune is that suppose if there is a deviation from the existing Ind AS standards, what should be the situation? Because what it says that you have to always follow Ind AS. Suppose if because of some regulatory requirement, for example, court has said that this is what you are supposed to apply, or some law has said that this is what you are supposed to apply. Because of that, you are supposed to deviate from the existing Ind AS. Whether that deviation is permitted, the standard says it's a rare of the rarest circumstances where there could be a possible deviation. In case if there is a deviation, which will make it relevant and reliable presentation, or maybe because of legal circumstances, you can still have a deviation. The moment you have a deviation, you have to explain the deviation, the impact on the financial statement compared to Ind AS, and why the deviation has happened. You have to have a information. That's what Aruna is mentioning. Current liability decision tree I have already explained in detail. We will also discuss that as part of our illustration. Then you will be more clear. Is there any requirement to disclose in the notes in the accounts where there is an error in the previous period items? Rubini, perfectly you are on the dot. Whenever there is an error, you cannot cover up the error in Ind AS. You have to necessarily say that as per Ind AS 8, how you have corrected those errors, and because of that, what are all the changes which has happened? That's the third balance sheet also comes in the assets and liabilities, which has been already offered or already approved by the stakeholders or shareholders. So it is an important requirement that prior period errors has to be corrected. Only possibility could be if the errors are not material, because the accounting standards and Ind AS are applicable based on the concept of materiality. If that error is, say, for example, only 10,000 rupees or 50,000 rupees, whereas the company's profitability is in crores, then that is not a material number. In a material number, there is no error which has to be corrected. And the moment you are correcting any error retrospectively, as per Ind AS 8, read with Ind AS 1, there should be a complete notes on accounts. What was the previous number? What is the nature of the error? How it is corrected? And what is the closing number? And the closing number, how it is cross-referred to the item in the balance sheet or in the P&L. Yes, it is required. Is third balance sheet required if the error was in previous year, which was correcting in current year? Good point. Suppose if the error was happening only in the previous year and not before the previous year, then the third balance sheet will not arise, right? Because you are not restating any number. That's a good point, Vijay Kumar. If the error has happened only in the last year, then comparative anyway I am restating and I am going to discuss or give the notes as per Ind AS 8. If the error is beyond the previous year, then the third balance sheet will come in. But in case of omissions of entries in books of account, the nature of expenses in 2017-18, then how make adjustment in 2019-20 and how it will be presented. Sneha is asking this question. Sneha, it is falls under Ind AS 8. So 17-18 is the error. So that error is not relating to the comparative period. So accordingly, the entire impact of the error will be adjusted in the opening retained as on 1/4/2018, and you will make a disclosure. Third balance sheet will also be presented. Retrospective restatement, I have given a lot of example, Tarun. PPT not available for download. I think they have already informed that it has been already included, including the PPT, but PPT is in a PDF version, it has been given to you, not as a PPT version. PDF version, it is already given to you. You can download the PDF version. PPT version is not able to be provided because we require a lot of changes which will be happening over a period of time. It is not possible. But all other materials like the illustration, etc. in Word file is also already shared, and working notes also for you to refresh at a later point of time. I have given that for the entire PPT material. So you can also make notes in that. What means decimals thereof? I think that it goes without saying. 2 decimals. 100.25 lakhs is a decimal. So rounding off with an example I have already made, Ayushi. Is asset are shown firstly? Is it mandatory under which division? I have already explained that division 2 of schedule 3 requires a format to be used. So asset will come as first. It's a mandatory. It is not optional. Yes, Aditya, it is as per division 2. Is there any conflict? Which is the requirement? If there is a conflict, what is the requirement, sir? I have already explained, Chidambaram, that if there is a conflict between Companies Act and Ind AS, Companies Act will prevail over. If there is a conflict between the presentation requirement as per Schedule 3 vis-a-vis the standard, Schedule 3 will prevail over. And okay, Vidya from Coimbatore is asking, suppose if you are correcting an error, what would be the impact on income tax return which is already filed? Actually, I don't answer a question on income tax impact of accounting standard, except talking about deferred taxes. But to answer your question as a student who are also preparing for your income tax purposes, the company, if they believe that the material impact will be assessed differently as a misreporting or underreporting, preferably they can file a revised return. If the time limit for revised return has already closed, they have to apply to the commissioner and get the time to file the revised return. If that is also not possible, at the time of assessment, there is a possibility that the assessing officer can treat that as a prior period income and open the assessment of the prior period and tax you in the current period for misreporting. That could be a possibility. Working capital cycle, to some extent I can say yes, Rohit, operating cycle is working capital cycle, but working capital cycle, cash to cash is normally coming in. What if a company has an operating cycle of more than 12 months? We have already explained that. Yes, 14 months could also be there. Is there any limit to minimum and maximum cap on operating cycle? No. Anupam Verma is asking from Thane this question. Anupam, as I have said, it is prepared based on the classification from the point of view of, for example, if I am talking about a real estate company, the operating cycle may be even 3 years, where the entity is actually doing a business activity of constructing a dam or constructing a road. Could be more than 2 years or 3 years. So there is no minimum or maximum cap which has been given. What it simply says is that if you are not able to determine what is the minimum, what is the operating cycle, take 12 months as operating cycle as a presumption. So it has given as a guidance. For example, if your operating cycle, when we are taking into consideration, it is less than 6 months, whether that is useful for me to make an assessment for current and non-current classification, I normally used to use one slide for the purpose of chartered accountants, but I have removed it. In a scenario where the operating cycle is less than 12 months, that particular condition is redundant. It is not useful for a simple reason. There is a overriding principle of the third condition, right? Third condition says whether you will be expected to realize within 12 months from the end of the reporting period. Even if my operating cycle is only 3 months, but your expected realization is within 12 months, still that will be overruled based on the operating cycle, right? So I normally used to give an example saying that if your operating cycle is 12 months, forget about that condition. That condition is not going to be any relevance. Second condition, third condition will give you a better result on current and non-current. So if assuming that I am saying your operating cycle is 3 months and you are expecting to realize a debtor within 12 months, then the first condition is not satisfied. But the third condition will allow you to treat that as a current asset, right? Because it's expected to be realized within 12 months. And to that extent, it is always better to ignore that first condition because it is less than 12 months. Operating cycle is less than 12 months. That is one crude rule which you can actually talk about that. On ICAI website, it's beside in YouTube. Maybe I will ask Board of Studies to answer this question. Acquiring of assets in operating cycle should be considered from date of order of raw material or from the date of receipt of assets and from the date of order current. When you are talking about the operating cycle, lead time for getting the material also taken into consideration. What is the operating cycle when raw material purchased is on credit? So the credit period is normally reduced. So when you are talking about raw material holding period and you are talking about creditors period, debtors holding period, normally you will reduce the creditors payment period also from that operating cycle. Practical situation, most company will have more than one vendor and multiple customers with different payment terms. Is it practical to calculate operating cycle and we should use 12 months a default assumption? Manoj, that is what I'm trying to say, that if the operating cycle is less than 12 months, forget about everything. Use 12 months assumption. Suppose in peculiar scenario, because in many business cases, always it will be less than 12 months. Only in peculiar industry, it will be more than 12 months. So in that case, try to identify that. Unfortunately, whether it's practical or not practical, you have to identify your operating cycle. That is what it has to be done. And you cannot simply go for 12 months as a default. It's not possible. You have to see. Unfortunately, that is what you are supposed to do. Operating cycle is essential for classification of current and non-current. Thus, the accounting to be done on estimation basis if finished goods is 7 months, then it exceeds 12 months. How shall we proceed? Sneha, I am not able to understand your question. Operating cycle is essential for classification of current and non-current. Perfect. Thus, the accounting to be done on estimation basis if finished goods is 7 months, then it exceeds 12 months. I think that you are trying to say that there is a old finished goods which is still lying in the books of accounts, and whereas I am preparing the financial statement on 31st March, how I will talk about expected to be realized. That's what I am trying to say. Expected to realized is to be determined by the management and it should be demonstrated. That's what you have to see. If the management demonstrate that, yes, within the next 7 months from the end of the reporting period, I will be able to realize my inventory, then you have to accept that based on the evidence available. A Limited is a owner of a land from 2017. In 2019, some third party illegally occupied the said land and claiming the same land as his own. And the issue is being dealt with in the court of law. Until the decision is announced, the said land shall be treated as contingent liability or other treatment is prescribed. Arun from Hyderabad is asking this question. Interesting question, Tarun. But if the title deeds are in the name of the company, and that is the way in which the company has actually treated that as an asset, there is an outflow which has also happened. And to that extent, it is not a contingent liability. Correct? So you have to recognize that asset as part of your asset, and whatever claim, you explain that there is a dispute which you are not admitting as a claim as part of Ind AS 37, provisions, contingent liability and contingent asset. But the asset will be a non-current asset which you will recognize in the books of accounts because outflow has already happened. Aniruddha is asking this question. For debtors said that it should be realized in normal operating cycle which was 14 months, but as per illustration the debtor realization was 5 months only. So we should take 5 months or 14 months. Aniruddha, whenever we are talking about any asset, not necessarily debtors, you should always compare with the normal operating cycle. If it is expected to be realized within the normal operating cycle, it becomes a current asset. So it is not based on your credit period of 5 months. You should always consider based on the normal operating cycle. In that example, normal operating cycle is 14 months and accordingly you should consider that 14 months as the period and you cannot take 5 months as the period for the purposes of current classification. What is unrestricted cash and cash equivalent? Nothing but cash balance, bank balance, fixed deposit having original maturity of less than 3 months, and there should not be any restriction. For example, I have a bank account in a foreign country and the foreign country has restricted transfer of funds from there here. So it is not available immediately to me and we do not know when the restriction can be removed. If such a restriction is there, fourth condition is also not satisfied for a cash and cash equivalent. Then it becomes a non-current asset. That is what restriction. If machinery is held for sale but not within operating cycle, then what? If it is not within operating cycle, we will test the third condition, Ranjit, whether it is going to be sold within 12 months from the end of the reporting period. If you believe that it will be sold within end of the reporting period based on the expected realization, it will still be current asset. But the moment where you are saying it is not expected to be sold within next to 12 months, Ind AS 105, non-current asset held for sale, says that the sale itself, and accordingly the classification itself is not permitted. So accordingly, if it is going to be beyond 12 months, you have to worry. But if it is going to be less than 12 months, but beyond operating cycle, for example, in your case, I am taking operating cycle is 6 months, but the machinery will be held for sale and expected to be sold within 9 months from 31st March 2020. Still, it will be a current asset as per Ind AS 1 for the year ended 31st March 2020 because 12 months criteria overrides the operating cycle in case operating cycle is less than 12 months. What about non-current asset held for sale? We have already explained. Please take an example of third condition, that is expected to be realized within 12 months. We have taken enough item. Thank you, Simona, for effective and good conceptual clarity. From 2002 onwards, I am doing only on accounting standards and IFRS, US GAAP and Ind AS. So that gives me the conceptual clarity, and also people like you are helping me to learn more whenever I am interacting with you. Please explain unrestricted cash. We have already done that. We have now explained. Operating cycle under multiple product with a different operating cycle. Veerabhadra is asking from Bangalore this question. I will explain this. Assuming that an entity is into real estate development and it is also doing some trading activity for building material. So I am just assuming that there is a trading activity as well as it is also constructs and develops properties. In that situation, it has two different businesses. In trading activity of building material, what happens? It buys and sells. The operating cycle will be less. The purchase of finished product, how much is the gestation period, how much period you hold it, and what is the gestation period for collecting your debtor. It will be normally less compared to real estate development, because real estate development, after you have constructed the entire thing, you are going to sell, right? So the gestation period or the operating cycle could be different. So what you are supposed to do is that what are all the assets and liabilities relating to real estate development? Keep that as a separate item, separate category. What are all the assets and liabilities relating to trading activity? Keep that as a separate category. Apply the operating cycle of trading cycle or trading activity business and identify for those assets and liabilities what is the current or non-current classification. For the real estate related assets and liabilities, identify the operating cycle of the real estate division and apply that period for the purposes of current and non-current classification. See, for example, 9 months is operating cycle for traded goods. You apply 12 months criteria because 12 months is more than 9 months criteria. So you apply that for current and non-current classification. So if any asset is expected to be realized after 12 months, it becomes non-current. Otherwise, it becomes current. Whereas in real estate division, you have determined that 36 months is the operating cycle. So any asset which is expected to realize within 36 months still be a current asset. So the third criteria of 12 months is no relevance because operating cycle is more than 12 months. Okay. So in that case, real estate division use 36 months criteria for classifying assets and liabilities. For trading activity, use 9 months criteria and read with the third condition of 12 months for the purpose of current and non-current classification. That is what Veerabhadra is asking. What if inventory is held for sale treated as favorable situation could not be sold? Danya, I have not picked up that particular question because it's relating to audit. But when I'm doing for the chartered accountants, I normally used to say, the moment you are saying there is an inventory which is not expected to be realized within 12 months from the end of the reporting period, that itself makes a question mark whether there is a write down to net realizable value has to be necessarily done, or a provision for slow moving or non-moving asset has to be done according to AS2. Since AS2 will be dealt with separately, I am not using that. But what will happen is, in your question, if it is not going to be sold, you have to make a provision and write down in accordance with AS2 subsequently. But you will always test it for NRV the moment you are saying it is not a current asset. Inventory is not a current asset itself is making a doubt whether it is saleable or not. So NRV testing has to be necessarily made. If the NRV testing proves that you will anyway realize it, no adjustment is required in the current period. But subsequently, when it is concluded that it is not going to be sold based on that particular situation, then you have to adjust according to AS2. Cash is nothing but cash on hand, cash at bank, in current account, in deposit account, all those things is that. So there is no requirement, specific requirement. Cash and cash equivalent we have already talked about, including restricted cash and cash equivalent. Inventory realized after 15 months, but as you teach that normally held for trading. So even if it is realized after operating cycle, then too it is current asset. Yes, Amandeep, it should be treated as a current asset. How to classify debtors if they are expected not realized in operating cycle, but the company is thinking of selling them to third party, securitization. So if the securitization will be happening, interesting question. I should appreciate Deepak, your knowledge. If they are going to securitize the entire debtors, then you have to see when they will realize the consideration for the securitization. Take that also as part of your assessment. Suppose if it is going to happen within next 12 months, then you can still treat that as a current asset. Otherwise, you will treat it as a non-current asset. Should we consider marketing expenses in operating cycle, as marketing is something sometimes needed to make a product realizable? Aryan, when current and non-current classification is applied, this is for balance sheet. And accordingly, expenses are not considered. Marketing expenses is an expenditure, and that is not part of the consideration for operating cycle. We have explained about the operating cycle. We have already given a lot of examples for that. Rounding off, there is a question coming from Lavanya. For turnover more than 100 crore, minimum mandatory rounding off requirement is up to nearest lakhs. So an amount in the balance sheet of 2 crore 45 lakhs 76,000 must be written as 245, or can it be written as 245.76? That's what I am saying. You can have it as 246, or you can have it as 245.76. So it says units of, in your example, it can go up to lakhs. So you wanted to present on lakhs, it can be full lakhs, 246 crore, 46 lakhs you can show, or decimals thereof, that means 245.76 also, it is permissible. Will the amount after decimal be considered as violating? No, it was saying that decimals thereof is also included in the condition. There is no violation. Maybe you have missed it when I am talking about decimals can also be provided. Anil Kumar from Vizag is asking, as per rules, if Ind AS once applicable to the entity, it will be applicable forever and it is one-way traffic. Does this rule apply to an entity which chooses an Ind AS voluntarily? Yes, Anil Kumar. Have used Ind AS to the first session which we have discussed. Shravani is asking, in current asset condition, 12 months after reporting period, this 12 months must be taken from end of the reporting period. Example 31/3/2020. Yes, not from the transaction date. That's what I think that your question, Shravani. It is not from the 12 months from the end of the date of transaction. It should be taken from end of the reporting period. That means 31st March 2020 is the end of the reporting period. From that 12 months up to 31/3/2021. If you are expecting to realize it, it's still a current asset. Inventory is held for sale, then always it is classified as the current asset. Yes, Sapna. What if they have investment having maturity period of 28 months? Naturally, no. So if I'm talking about 28 months is the maturity period, first condition, it is not operating cycle. Second condition, is it held for sale? No. Third condition, is it expected to be realized within 12 months? No, because it is expected to realize only at the maturity period, which is 28 months. Last condition, cash and cash equivalent? No. Accordingly, this investment will be treated as a non-current investment. Prabhakar Jain, that is whether a portion of the debtor can be ignored for the current and non-current classification. I'm not sure what Samyuk is asking this question. My feeling is, if, for example, there are 234 lakhs of debtors outstanding, I am connected. No one is sharing video. Whether I am visible to you? Hello?
Yes, sir. Sorry, sir. I was talking to the vendor. Yes, sir.
Okay. When I had a doubt whether I'm disconnected because my internet connectivity going and coming and I'm
Yes,
using
sir,
an
your
alternative
screen was
connection. Okay, perfect.
Yeah, your screen was hang in between. You can take 5 minutes break and sort out the issue if you wish.
It is already, I'm visible now or not visible?
To me, you are visible.
For the participants also, then it should be visible. Yeah. Then I will continue with the questions and then I will go for the sharing. Absolutely no problem for me.
Okay, sir.
Okay. So in that example, Samyuk is asking the question whether a portion of debtor can be ignored for current and non-current classification. There is no ignorance. You cannot ignore any portion of an asset or liability just for the classification. But what happens is, assuming that 234 lakhs of debtor is there, out of which 50 lakhs of debtor is under dispute and accordingly expected to realize after 12 months. That 50 lakh you will show as part of non-current classification. Balance 184 lakhs you will show as part of current classification. So that is the only thing which you can do, but you cannot ignore any portion of asset or liability. Lavanya, I have already answered this question. I think that you have written it again for the purposes of, since I have not added. Unrestricted cash and cash equivalent we have already talked about. If investment is held for sale after 5 years, will it be classified as current asset? No, because it is expected to, the probable sale should happen, right? So if somebody is saying that I'm going to sell it after 5 years, it's a non-current asset. That's what I have mentioned. What is mean by held for sale? Held for sale means it should be probable that the report period. Can he give another example how to classify two types of activity? I have already given that example for a real estate business. Reporting period means, reporting period is nothing but the period for which you are preparing the financial statement as per Ind AS. For example, the reporting period when I am saying 31/3/2020, 1/4/2019 to 31/3/2020 is the reporting period. The reporting date is 31/3/2020. Yesterday we left the topic departure from requirement. Now I have covered Parameshwari. I have covered it. You are from Devakote, right? Chettinad. Priyadarshini from Chennai, example of interest on corporate bonds under current and non-current asset. A simple idea, Priyadarshini, assuming that I have invested in a bond which is maturing after 5 years. The bond itself is a non-current asset. So I have to show that as a non-current asset. Suppose that the interest is payable every year. That means whenever it is payable in every year and payable, say for example, on 10th of April of the next year. So 10th of April next year for the interest accrued portion, it is going to be realized within 12 months from the end of the reporting period. So the interest accrued will be treated as current portion, but the bond is going to mature only after 5 years. So it's a non-current portion. Okay. There could be another possibility. The bond. This is another example arising out of it. This is a bond where the interest itself is accumulating interest. That means it is not payable every year. It will be paid along with the principal at the end of the 5th year. Then that interest accrued is also non-current because it is not expected to be realized within 12 months. It is expected to be realized only after 5 years, right? So you have to consider all these things. Whatever question you are having, for all of you, I'm just suggesting that please consider the thing what we have actually talked about as a flow chart. You will get an answer perfectly on that. Operating cycle creditor period should be subtracted. Yes. Okay. When we will get the PPT for AS1, it is already uploaded. If the contract says deferred payment sale and there is an outstanding beyond 12 months, if it is a payment terms, I'm just thinking that it's a liability. So due to be settled itself is beyond 12 months from the end of the reporting period, right? So to that extent, I will show that as part of your non-current liability. What is due within 12 months, I will show as part of current liability, and the balance I will show as part of non-current liability. Pallavi is asking how about 8% interest for the remaining period to be treated. In the example which I have taken, I was talking about interest is payable annually. That means every year the interest is being paid. So accordingly, no asset is arising for the remaining period. It is due only in the subsequent period. As and when it is due, it will be accrued. So nothing to do with, in that case, we have to talk about operating cycle. No, operating cycle should not be from the year end. Operating cycle will be a normal business cycle. The current liability is distinct. Fourth condition is whether the company does not have unconditional right to defer settlement. I will take an example, Vikram, and then I will explain. Can we interpret at least 12 months in current liability stream as it at least more than 12 months period can also be treated as current liability but not non-current liability? No. Sorry, if I'm saying at least in that example, I don't think so. I think that in that decision tree we were saying that expected to due to be settled within 12 months is what I have used it. If there is an at least which you have interpret, that is incorrect. So you cannot decision tree. If item is reclassified as non-current asset held for sale, then we have to prepare third balance sheet. Reclassified as non-current? No, because it's not an error, right? This year only you have taken a decision to reclassify that as held for sale. So accordingly, third balance sheet is not required. If there is an error in the previous year only, third balance sheet is there. Shikar is asking that question in last lecture illustration, did not ask doubt because I thought it's a part of the question who was not relevant to India's one, but asking now for understanding how does removal of import duty appropriate home currency. It will be taken by somebody else. So I'm not considering that as part of our discussion. We will leave it as it is. Specify answers in the frequently asked questions compiled in PPT. Please note down whenever I am explaining the answers. Please take down the answers. It is not possible for me to share the entire answers in a later place. I have entered into an agreement for sale, but due to some worst case scenario, it could not be sold due to some difficulty from the government. Okay. Chidambaram, you are trying to say that I have planned to sell it within 12 months, but there is some situation like COVID situation like that situation has happened. Whether that will impact the classification. One of the point which is actually saying that still my intention continues to be there, but the restriction is beyond my control. You can extend the period. There is one condition which is coming and India is 105. So you can use that principle here also. If any asset has life of 1 year and thereafter it has to be sold, then what would be the classification? Life of 1 year and thereafter it has to be sold. So it will be still a non-current asset. From the asset, you are selling that as a scrap. So that no change will happen for that. It will be a non-current asset only. Basic understanding are very useful. Thanks a lot. Okay. For arranging that. The credit should go to the Board of Studies because they are considering the students who are throughout India who are not able to access a regular coaching face to face. They should also get benefited. That's the reason why Board of Studies is taking this initiative. And that is the only reason why I am also coming forward to part of this particular situation. Vikram, time limit generally 12 months. However, there is an inventory which is non-moving stock of 5 years and it will not be sold due to technological changes. That's what I have told you, Vikram. Whenever there is inventory which is not expected to be sold, necessarily a write down will come as per Ind AS 2, but still it will be shown as part of your current asset only. But the entire provision may be taken. Whether these illustrations, Danya, you are asking this question, whether these illustrations are relevant for old syllabus students writing in November 2020. My feeling is that this entire course is for the new syllabus students. That has been very clearly explained. If you are writing old syllabus and Ind AS is not fully part of that, it is only overall framework, these detailed illustration may not be relevant to you, Danya. I have answered all the questions which has been posted as of now. What I will now do is I will go back and continue with the Word file which we are talking about to answer on the current liability. You are able to see the screen, right, on the Word file. So here what we are talking about is that we have seen the case of the bond. I think we have already done that. Company has you are able to see me or no? A presentation is not there. Some Word file is being seen on the screen. Hanging. Internet is a problem. But the
no, sir, actually, Upin, Devang, please just mute for students. Actually, sir, on ECPL TV, your face was visible, screen was not visible because you were taking up the queries. However, in Blue Jeans, we were seeing your screen. Whatever you were sharing the Word file, that was visible. But on ECPL TV, which was telecast, which was webcasted to the students, there your face was visible, and you were taking the queries. Right now, so he left, joined.
Again, I come back or?
Yeah, you came back. Sir.
So I understand what you are explaining. Now I will share the Word file. This Word file is now visible, right?
No, I'm not able to see. Devang, if you are able to see, please check.
You're not able to see.
No, sir, it's not visible.
Again, I will share this file. There is some network issue which is coming in. Actually, one problem with
What, sir? The again went off. So you दिवांग आपने वहां पे वो कर दिया ना बच्चों आप बच्चों को ना प्लीज वो कर दीजिए प्लीज यू जस्ट शो ऑन दैट की 5 minute break so that meanwhile sir can set the resolve the
video, but you have to see clearly able to see my hear my audio because I have some internet connectivity issue. So hopefully you which is unexpected. On the statement of profit and loss account, we have the second component of the issue, which is the profit and loss account. We have two statement approach where we are talking about a financial statement will be, especially the profit and loss account will be split into two categories. Into comprehensive income statement and other comprehensive income statement. This is what is a two statement approach. Comprehensive income statement is nothing but the profit and loss account. Other comprehensive income statement is one of the new element of Ind AS format. The other comprehensive income is a other new element which we are going to discuss, and I will show you how it is into this. The nature of expenses is a classification which is permitted. What does it mean by nature of expenses model? When we are saying this nature of expenses model, IFRS actually allows you, as per IAS 1, whether you can show the expenses in the profit and loss account based on the nature. For example, depreciation is a nature, finance cost is a nature, employee cost is a nature, cost of material consumed is a nature. So instead of showing that, you can also show as a functional basis. For example, I can say cost of goods sold, which includes material consumption, direct labor cost relating to that, depreciation relating to the manufacturing asset. All those things are part of the discussion which is coming in respect of the functional basis. For example, if I am talking about administrative overheads include salary of the administrative people, depreciation of the machinery used in the corporate office or furniture and other items, equipments used in the corporate office, and any other related items. So when you can classify based on a function, production overhead, administrative overheads, selling overheads, you can do that. But that is permitted only as per IAS 1. It is not permitted as per Ind AS 1. Ind AS 1 permits only nature of expenses model. Here IAS 1 gives nature and also functional basis. Two bases are permitted as per IAS 1. But Ind AS 1, only one option. That is the nature of expenses model. Functional basis is not permitted. This is one carve out which we have considered, but the carve out is not separately mentioned in the mandatory and the optional carve out, because any option when it is deleted, IFRS Foundation believes that it is not a carve out. If I am bringing something new than what is given in IFRS, then to that extent it comes as part of carve out. So this is the difference between IAS 1 and Ind AS 1, but not a carve out, because we are only deleting the option. The format of the P&L again is defined by Schedule 3 of the Companies Act. If you see the comprehensive income, what it consists of, it is whatever is the information which is arising out of the total income minus the total expenses relating to the normal operation of the company. What is other comprehensive income? It is certain items which cannot be part of P&L item, because it says that the standards defines that you have to have it as other comprehensive income. In simple terms, most of the items in other comprehensive income are unrealized gains and losses, which will be on settlement or disposal of a particular asset or a liability, will be taken to the profit and loss account. That's what other comprehensive income is all about. But at the same time, entity cannot decide which item they wanted to put it in other comprehensive income, because it's like a mandatory rule that these items should be always in other comprehensive income. In fact, it says that an Ind AS defines which item should be part of the other comprehensive income. So the moment I'm saying that this particular item has to be there in comprehensive income as per the standard, we have to have it. Just for putting you, there is one, before I go into OCI specifically, one point to the concept of extraordinary items is prohibited as per Ind AS 1. You cannot hold any item as an extraordinary item. Exceptional item, because Schedule 3 gives an option to show certain items are exceptional item, still it is permitted because of Schedule 3 overrides the Ind AS 1. But extraordinary item prohibited both under Ind AS 1 as well as Schedule 3. So there is no more extraordinary item in the statement of profit and loss. Coming to the mandatory items which we have talked about in OCI, there are 9 items which has been shown as part of other comprehensive income. Other than this, no other item can come in other comprehensive income. For example, if you are doing a revaluation as per Ind AS 16 or Ind AS 38 for intangible asset, that revaluation surplus cannot go to P&L. It should go to other comprehensive income. When you are doing a measurement of defined benefit plan, there is an actuarial gains and losses which is coming in. Those actuarial gains and losses should go to other comprehensive income and not to P&L. when you are talking about translating a foreign operation into India as per Ind AS 21, we call it the foreign currency translation reserve. That foreign currency translation reserve impact cannot go to P&L. It should be routed through OCI. And similarly, when you are having certain equity instrument designated as fair value through OCI, the fair value changes compared to the previous period should always be in OCI because you have defined that. Similarly, any other financial asset where you have applied fair value through OCI, that should be treated as part of OCI, other comprehensive income. If you are using a cash flow hedge, the cash flow hedge should also come as part of other comprehensive income. In case if you are changing any fair value which is attributable. So these are all the items with respect to the separate standard. For example, when you are reading Ind AS 109, they will say what item should go to P&L account, what item should go to other comprehensive income. For you, as far as Ind AS 1 is concerned, I am not going to deal with these items in detail because respective standard will deal with that. For your simple understanding, other comprehensive income means if a standard says this item should be dealt with in OCI, you have to put it in OCI. Otherwise, it should be normally in the comprehensive income. That is very simple example which I can talk about. And when we are talking about the information to be given in the notes on accounts, for your understanding, it's basically you have to specifically mention certain items necessarily. Any write down on inventory or property, plant and equipment where you have done an impairment testing, disposal of items of PPE, there should be a disclosure. Disposal of investment, there should be a disclosure. Discontinuing operation, there is a disclosure. Any litigation which has been settled in the current period and the impact of that should be part of that. Any restructuring activities, for example, I have introduced a voluntary retirement scheme, that should also be part of the disclosure. Any other reversal of provision, these are all the mandatory disclosure to be part of your notes and accounts, apart from regular requirement based on certain specific accounting standard. This is what the notes and accounts should be. Coming to statement of changes in equity, we have dealt with in the previous session itself because it's a new component and I have explained that it will be shown on a tabular format combining the movement in equity share capital as part A, and we will show the movement share premium, capital reserve, other comprehensive income, and also the items relating to retained earnings. We said that we will show opening balance and what are all the movements. That is what statement of changes in equity is concerned. When it comes to statement of cash flows, what it actually talks about is that it should be based on your format in Ind AS 7 and the preparation should also be in accordance with Ind AS 7. In simple terms, Schedule 3 has not given any format. Ind AS 1 has not given any format. You have to go to the format as given in Ind AS 7 and your preparation will be governed by the principles of Ind AS 7 statement of cash flows. On the notes and accounts, what are all the things has to be there in the notes and accounts? In the structure, one is basis of preparation of the financial statement. What is the significant accounting policies? And this is one thing interesting. This is one thing interesting. In fact, I should have discussed as part of one of the case study. I wanted to take it at a later point of time. This we will discuss a little bit at length. Explicit and unreserved statement of compliance with Ind AS. What does it mean that? Whenever you have a financial statement in your Ind AS basis, after the basis of presentation, you are supposed to have one paragraph where you say, in the preparation of the financial statement, all the applicable Ind AS has been fully complied with. So what we are saying, explicitly we are making a statement that we have complied with the Ind AS. And what is the other portion saying? All the applicable Ind AS has been complied with. That is an unreserved compliance with the Ind AS. In simple terms, I am saying all standards have been complied with. I am not having any reservation of excluding a standard. We have done it in full. Explicit means this paragraph should be part of the Ind AS financial statement in the notes and accounts. If this paragraph is not there, it is considered as a non-Ind AS financial statement. So this particular paragraph is mandatory requirement to be included as part of an Ind AS notes and accounts, right? So explicit means explicitly I am stating that it has been prepared as per Ind AS. Explicitly I am also saying I have complied with all the applicable accounting standard. No standards have been excluded. For example, if one entity says understanding of standards on financial instrument, Ind AS 109 becomes a complicated affair for me, and to that extent I have not complied with the requirement of Ind AS 109. All other standards have been complied with. That is not an unreserved compliance. This is a reserved compliance because you have not applied Ind AS 109. Not possible. Explicit and unreserved statement of compliance with Ind AS should be part of the notes and accounts. If this paragraph is not there, or if this particular comment is not there, even if you have prepared the entire financial statement in accordance with the requirement of Ind AS, still it will be considered as a non-Ind AS financial statement. So very, very important disclosure. If you see illustration 4, which I have given in Word file, I specifically talked about that. I have actually discussed that entire thing for you. This paragraph should be there. And interestingly, to understand the financial statement, where the user of the financial statement has to understand what are all the judgments involved in applying certain accounting policy. For example, I make a judgment that the economic useful life of property, plant and equipment is 50. On what basis I make the judgment? Another case which I can give an example is that I am recognizing current tax. On what basis? Current tax is recognized based on the tax provisions applicable to the entity, tax laws applicable to the entity, and what are all the tax jurisdiction in which I am working. There may be some cases where I will be entitled for some tax exemption. I have considered those items as well. That's a management judgment. And another thing is I am making a provision for doubtful debts. What is the basis of providing for the doubtful debts? Why I am making a basis? For example, if the management says I make a provision for doubtful debts if it is more than, say, 6 months outstanding. Why you have concluded only more than 6 months as a doubtful item? Why not it's more than 5 months also? Why you have considered that judgment should be made known to the user. So the user will be reading in the notes what is the management has taken certain judgment in taking certain accounting policy and whether the judgment is acceptable. If it is not acceptable, what would be the impact on the financial statement? The user should be able to understand. That is the reason why the management judgment also comes as part of the requirements of the notes and accounts. And again, management makes certain assumptions. For example, when management makes a provision for gratuity, it makes an assumption that the attrition rate is 7% and the salary increment will be 10%. From where you have got that? What is the source for that assumption? Whether that is acceptable to the preparation of the financial statement. So the key assumptions and what is the source which has been taken by the management should also be discussed as part of the notes. And wherever accounting standards, that's the Ind AS, are requiring any disclosure, specific disclosure. For example, if we are talking about borrowing cost, Ind AS 23 requires you to disclose what is the borrowing cost capitalized during the year. That should be part of your notes and accounts. Ind AS 109 relating to financial instruments requires what is the risk relating to holding the financial assets and financial liability. How the management is managing the risk, how they are mitigating the risk should also come as specific disclosure as per 109. And if you are talking about property, plant and equipment, it requires you to show what is the opening balance, what is the acquisitions during the period, what is the amount which has been disposed of during the year, what is the amount which has been made as a depreciation for during the year. All those things should come as part of your disclosure relating to that. So that is another disclosure. In simple terms, the disclosure required by Ind AS 1 is over and above the disclosure requirement of the respective Ind AS standards. So if I have to comply with out of the entire standard, say for example 32 standards are applicable to me. For each of the applicable standards, have I made the related disclosure should also be looked into. Sometimes some specific law requires some disclosure. For example, if you see, there is a law called MSME disclosure rules, where there is any dues which are requiring to be disclosed. If it is due to a micro, small and medium enterprises, what is the amount due, whether it is outstanding for more than 45 days, all those things has to be disclosed. So this is a statutory requirement. When it comes, that should be in addition to. This is in addition to Ind AS 1. Ind AS 1, whatever it requires, this is an addition. Specific disclosure is also an addition. So these are all the additional disclosure which has to be done as part of the notes on accounts. Now, we come to certain quick questions. Can a company disclose earnings before interest, tax, depreciation and amortization? Because Schedule 3 format is not substantiating this particular format. And accordingly, whether it is possible, it is a question mark. To that extent, Schedule 3 is not specifically allowing this to be done. When we are talking about pro forma financial information, can I include in the financial statement? Normally, the financial statement should be your current financial statement and not pro forma financial statement. So if entity wanted to give some pro forma information, for example, if they are saying next 5 years, this is what we are expecting. So our balance sheet will look like in the next 5 years like this. So that we should ask them to specifically exclude from the presentation of financial statement. It can go to the director's report or another thing which we call management discussion and analysis. I should say management discussion and analysis, MD&A. So here we will ask them to include it and not put on the notes and accounts. Assuming that the entity is having certain items of exceptional, maybe some major expenses during the year. For example, they have lost heavily on forward contract. Mark-to-market losses has come very heavily. They wanted to show EPS before mark-to-market losses of foreign current forward contract so much, after adjustment of forward contract so much. Whether it is possible to disclose that type of adjusted earnings per share, not permitted, because you are trying to mislead the user. You have already incurred some losses, but you are trying to show that these losses are not part of my operation. It is going to be something different. So adjusted EPS is not possible, but you can show the forward contract MTM in case if you felt that it is an exceptional item, not going to recur in the future. Because Schedule 3 format allows EPS calculation, you cannot show adjusted EPS. Exceptional item still permitted because of Schedule 3. That's what we have said. Schedule 3 permits, right? Because of that, we will be able to do that. But exceptional item, we have said that it is not possible. Suppose if an entity on the face of Schedule 3, we have certain items. For example, I have cost of material consumed, changes in inventory, finance cost, employee cost, depreciation and amortization, other expenses. But the entity wanted to show a particular item on the face of the profit and loss account or something as part of the balance sheet. Is it possible? It is permitted because Ind AS 1 says, if it is relevant and reliable presentation, you can still have additional line items included in the financial statement. For example, one of my client who is in hospital industry, when they have followed Ind AS, they wanted to show out of the total expenses which they are incurring, the major cost goes to the consultant doctors. So on the face of the P&L, they wanted to show payments made to doctors and consultant on the face of the P&L. Because of Ind AS 1 allows this relevant and reliable presentation, because that 50% of the total expenditure. We have included that line item on the face of it. Ind AS 1 permits that to be added. This is the conclusion of this session with respect to the presentation. What I will now do is I will try to share the balanced questions which we are going to have on that. I will share my Word file where we will take the illustrations quickly and then try to answer those questions. You are able to see that Word file now on your screen?
Yes, sir, visible.
Okay. So we have seen up to illustration 8. I will consider quickly the other illustrations. And illustration 9, we have already seen for a bond where it is repayable after a particular point of time. But the interest is payable annually. We said that the interest will be considered as part of your current liability, whereas the bond will be treated as a non-current portion because repayment happens only after 12 months. And when we are talking about the stock holding period and other things, 3 plus 1 plus 5 plus 5, we have said that 14 months. This also we have considered. Somebody has asked a question, what is the situation of two different reporting period? And I think that this question we have already considered, real estate transaction with a different example. And this question has come in the first session itself. I have not answered it. I'd say I will come back. Suppose electricity deposit, tender deposit, GST deposit which has been paid on dispute. What is the classification which we have to apply? Interestingly, when I have electricity deposit which I have given to the electricity corporation, when I am surrendering the connection, I will get that money back. But when I am going to surrender, I am running a business as a going concern, so it will be normally for a longer period. So to that extent, the question comes is, because it's repayable on demand, when you are surrendering the connection, whether I have to classify that as a current asset or I should consider it as a non-current asset. So expect it to be realized from the management point of view. Management, if they are saying I am not going to close that business in the next 12 months, automatically third condition fulfilled. So electricity deposit will continue to be shown as part of non-current asset. And tender deposit and earnest money deposits are paid for the purposes of participating in the tender. Once the tender has been won, the deposit will be refunded or adjusted against the amount that you have to pay towards the tender consideration. And accordingly, depending upon when the tender will be closed, it will be current or non-current. So within 12 months, the tender will be closed, then it becomes a current asset. If it is going to be recovered after 12 months from the end of the reporting period, that will become non-current. When I paid some GST deposit in respect of a demand which came from a GST department, I am disputing that. I have gone for an appeal. But appeal, when I am going, they are saying minimum 20% should be deposited. I paid the 20%. That I am showing as part of my asset as a recoverable amount, because in my view, I will win the case. So that means I am not making any debit to my P&L account. I am showing that as an asset. Whether that amount paid under protest has to be shown as current asset or non-current asset. Again, what is management expectation? When the litigation is expected to be closed, if the management believes that the then you will consider that as part of current, or otherwise you will consider that as a non-current. If it will be more than 12 months, you will show that as non-current. Income received in advance. For example, you have received income in advance from the customer, assuming that you are giving a annual maintenance contract. That is your service industry. You are a service industry and you collected annual maintenance contract for 3 years, for which upfront amount has been collected. What to do with that amount which has been received in advance? That received in advance is when it is going to be reported. Normally this will be a liability relating to, somebody has asked the question, when I have taken a trade payable, whether I will adjust in the operating cycle. Similarly, when I have taken a advance received, that will also reduce my operating cycle to that extent. And to that extent, what I will do is that I will consider that as part of the normal operating cycle and classify as the current liability. The illustration 14 is talking about the loan facility has been. This is relating to a case where I took a loan, there is a terms and condition, and I have not met the terms and condition. What will happen? That is what we said about the reclassification of the term loan into a current liability when there is a non-compliance with a loan covenants. Here it is to be repaid within a period of 9 months from the end of the reporting period. The moment I am saying 9 months from the end of the reporting period, automatically that comes as part of my current liability, right? Within 12 months from the end of the reporting period, I have to repay. Prior to the end of the reporting period, the entity and the bank entered into agreement whereby the existing loan will be unconditionally rolled forward as a new facility which expires after 5 years. So what happens? What is repayable within 9 months now replaced by a 9-year loan. So in that case, how should the loan be classified in the balance sheet of the entity? Because now roll forward and the entity has an unconditional right to defer settlement beyond 12 months. It becomes a non-current liability. That's what you are seeing here. You are seeing here that is as part of your point. The first point is the loan is not due because 5 years is the rollover period. Because 5 years is the rollover period, you will treat that as a non-current liability. What is the second question which says that suppose if I am saying that whether the answer will be different if the new facility is agreed upon after the end of the reporting period, what happens for the 9 months, what is due as at the reporting date? At the reporting date, it is due to be settled within 9 months. I do not have an unconditional right to defer settlement. It has come only subsequent to the year end. Because it's coming subsequent to the year end, I cannot reclassify that particular item as a non-current liability. I have to classify that as a current liability because I don't have an unconditional right to defer settlement because the new facility has been agreed only after the reporting period. Suppose in case the existing facility is from one bank, that's a loan which is due from 9 months, and the new facility from another bank, how I have to define? The new facility rollover has received from another bank. That facility will be shown as a non-current from the end of the reporting period. Whereas the 9 months amount which I am supposed to repay has to be treated as a current liability because the entity does not have an unconditional right to settle beyond 12 months. Fourth, if the answer A will be different if the new facility is not yet tied up with the existing bank, but the entity has a potential refinance obligation. In that case also, unconditional right to defer settlement is not existing as at the reporting date. And accordingly, in the first case, it is possible to show that as a non-current, it's a current liability. In the second case, because it is rescheduled, it becomes a non-current liability. In the third case, it is a current liability. Fourth case also, it's a current liability. Okay. So you are clear on this. Now coming to the next question, there is a breach of material condition. And what we are saying is that as a consequence of that, in the month of May 2002, the company started negotiating with the bank not to demand payment. So subsequent to the year end only, they are started negotiating, and accordingly, what is the classification which I have to apply, current or non-current? What it says is that paragraph 74 is that particular paragraph. It says that whether you have an unconditional right to defer settlement, and accordingly, in this particular settlement, particular case which we are talking about, if the financial statements are approved in June 2002, what would be the situation? So this is an event occurring after the balance sheet date. Based on the event occurring after the balance sheet date, can I reclassify? So in this particular situation, the liability will be treated as a current liability because whatever has happened is only in June 2002. Whenever it is happening in June 2002, there is no possibility of I'm using that before 31st March 2002 and classify that as part of my non-current liability. It is repayable on demand, and accordingly, there is a breach which will be exercised, then automatically it comes as part of your current liability because the negotiation or the approval comes only subsequent to the balance sheet. A similar question which we are having, where again it comes as part of your discussion. The dates are, what is the date which has been agreed? It's December 2011, and March 24th the entity has not able to give the promoter's contribution which came as part of the condition. March 25 they got a grace period of June 30. So what has happened? I'm not able to meet the conditions. So I have went and I should have considered that on 24th of March itself I have to fulfill the condition. I went and got the grace period up to June 30, 2012, and accordingly, whether I can say that whatever non-current asset which I have, non-current liability which I have got, whether it should be classified or not, as current liability or not. That's the only question which they are talking about. If you see that this is what is happening, you got only grace period of June 2022. Okay, when we are saying June, sorry, in our example 2012 we are talking, up to June 2012 only you got the exemption. That means it's repayable within next conditional settlement beyond 12 months is not available. So accordingly, the term loan, even though you have renegotiated and got 3 months of grace period, still it will be treated as only a current liability. From non-current you have to reclassify to current. Suppose what is happening is in the second question what we are saying is that assuming that in anticipation that it may not be able to get the promoter's contribution, the entity approached the bank and got the compliance date itself is extended. Original compliance date is 24th of March. Compliance date for bringing the promoter's contribution, they got it as June 30th, 2012. What would be the situation? In that situation, as on 31/3/2012, I do not have any breach of covenant because the condition itself is postponed to the subsequent period, and because the condition is not applicable as on 31/3/2012, I do not have any impact. And accordingly, in that particular situation, the breach is not actually taken place within March 2012. It happens only if it happens in June 2012, I have to make an assessment. And accordingly, in the current period, because this condition itself is postponed to June 2012, I am still entitled for managing that as part of non-current. This condition is what we are talking about is parent company has extended a loan to the subsidiary company, and how it will be classified in the parent company and subsidiary company. This is an interesting question because what happens is in the parent company it is a asset. In the case of the subsidiary company it is a liability. For the liability what we have said, what is the date on which you are supposed to pay? It says provides a loan, and the loan whenever the loan is demanded back by the parent company, subsidiary company has to repay. That means what? The loan is repayable on demand as far as the terms and condition is concerned. So when we say it's repayable on demand, what will happen for the issuer? That's the parent company. Suppose if the treatment will be different for parent company with the subsidiary company, you have to be little careful. I used a specific condition distinguishing between the condition for current asset and the condition for current liability. In current asset, I said expected to be realized has to be tested from the point of view of the management. In current liability, we have said that due to be settled has to be determined from the point of view of the person preparing the financial statement. Let us start with the subsidiary company. In respect of subsidiary company, when it is due to be settled anytime, it will be called for. That means it's repayable on demand. Third condition is also fulfilled. Fourth condition is also fulfilled because it doesn't have an unconditional right to defer settlement beyond 12 months. If the recall has happened within April in the next year, I have to pay. Even if it is not called for the full entire year, I do not know, because the control is not with me. Control is with the parent company. So to that extent, what happens in my books of accounts as a subsidiary, I should go with what is my conditions. It is repayable on demand, and to that extent, third condition and fourth condition are not satisfied. Right scenario, I should treat that as a current liability because it's repayable on demand. Due to be settled, unconditional right to defer settlement, both are not there, right? So I have to consider. When it comes to the case of the parent company, it is an asset. In the asset, what we are saying, is it expected to be realized within 12 months from the end of the reporting period? We assume that this loan has been given to support the subsidiary, and the parent company has decided that it will not recall that loan for the next 12 months, but it is not communicated to the subsidiary. For the subsidiary, the term remains as repayable on demand. From the parent company, we have decided even though the loan is repayable on demand, we will not call for it within the next 12 months. That means it is not expected to be realized within 12 months from the end of the reporting period. And to that extent, it is considered to be part of your non-current asset from the point of view of the parent company. The same item, depending upon current classification of an asset and current classification of a liability, will have two different situations. I think I have considered all these things because we lost certain time in respect of connectivity. What I will now do is that I will go into the question and answers which you might have posted. Quickly, I will take it up. To that extent, I have not covered this particular aspect. I will just open the download that questions, and then I will try to look into that whether there is any specific questions which I have not answered. I'm just downloading. It will take a few minutes. So I have entered into the thing. I am just downloading this question. It has downloaded. To that extent, I have not answered the questions. I will just consider as part of our discussion. Just give me a minute to format this.
So by the time you can stop sharing your screen and you can see your video.
I will stop sharing my screen. Yeah, I will stop sharing my screen.
So you can show your video. So if your connectivity is okay.
Yeah. I'm connectivity is now it's okay. There is no problem. But I don't want to get into the same problem again. So I'm still not showing my visibility. So let us try to discuss these questions showing my face on the screen. Okay. I'll just go into the questions. Going into the questions, which I have already answered. Those questions we will skip because it downloads all the questions. And we have talked about. Okay. We are talk about. Okay. One of the questions which is coming in is that in an it is 3 months, then we consider situation of 12 months naturally, because that's what I have mentioned, that whenever you are having a situation of say for example anything expected to realize after 12 months, the third condition, if it is satisfied, it becomes current. So we will apply that principle. And Mega is saying that the fourth condition relating to current liability is not understood. When I have taken an example, you will understand. Whether I have an unconditional right to defer settlement beyond 12 months means what? I will take a simple example for you to understand. I took a loan from a third party, and the third party says, on the due date, either you can make the repayment or you can roll forward for another 3 years period. So what it happens? I have the right to roll forward that loan. I need not pay that, but I can roll forward that loan. So I have an unconditional right to defer settlement beyond 12 months, right? Roll forward to 3 years. So 3 years when I am roll forwarding, it is beyond 12 months. I have the option which has been given by the lender. So accordingly, within my control, I can decide whether I can defer it for further 12 months. In that condition, that is what the fourth condition is, an example which I can talk about. Machinery, we have already discussed how to memorize all these standards. Do we have any knack for it? Otherwise, what I was actually tried over a period of time is I took the numbers of Indian standard and tried to create some sort of connectivity. For example, if you are talking about the standard on revenue recognition, we have AS9, whereas revenue recognition is previously considered based on AS18, Ind AS 18. So double of that is what I had. But now that logic is not working. When I was having another case where we talked about AS6 and AS10 for the purposes of property, plant and equipment, we have considered Ind AS 16. So 6 plus 10 is added to 16. That's the way in which I try to understand the number, giving some logical expression. But now that logic is also gone because AS6 is now it's deleted. So it's over a period of time you will memorize the standard numbers, nothing to worry about it. And your way of teaching makes Ind AS easy and brings more confidence. This is one thing which I always wanted to tell Girija, is that people are always have a worry about Ind AS, but I always believe that Ind AS may be little difficult, but not impossible. If somebody is saying, in fact, I started firing one of my close friend who is also a faculty, and he has conducted a session in the Institute of Company Secretary, where somebody who is not having a commerce background has asked the question, Ind AS is mandatory for us to have an employability. How I can remember that? Maybe in a lighter vein, he has made a statement that you people are not having a commerce background. It is very difficult for you to understand. Only God has to say. Then I get into the stage and said that this is an incorrect statement. If you are taking the effort, you will be doing it. Please have that confidence. You will be able to do it. Nothing to worry about Ind AS. You will score extraordinarily well on this particular point. Are there any other books for practicing more? My suggestion is work out on the last 5 years RTP, last 5 years practice manual, and also what is given in the study material. That is more than enough for preparing for your examination. Company acquires a 220 years non-listed company and merge it with it. Will the Ind AS conversion be done for acquired entity for last 20 years? No way, because the listed entity acquires that. Listed entity must be already preparing as per Ind AS. When it is merged with it acquires a non-listed entity, the other entity is actually merged. Accordingly, the listed company continues to be a listed entity, and accordingly, there is no restatement at all. It's coming in. Ind AS 103 business combination is talking about what you are supposed to do with respect to an acquisition. That will be separately considered, so I am not getting into that. Interest paid on loan after moratorium period is a current liability. Interest payable on loan will be a current liability after the moratorium period. If the moratorium period gets completed within the next 12 months, it will be a current liability. If the moratorium itself is extended beyond 12 months, then it is a non-current liability. So you should always consider that particular situation. How much time restriction should be there for cash balance to be classified as non-current asset? Absolutely no restriction. When we are talking about restricted cash balance, you cannot utilize it. That's the only restriction. Example which I have given, you have a foreign bank account, but the foreign country has stopped allowing transfer of that money here. That is a restricted cash balance. Whereas in respect of cash balance, I can use it anytime, or I can simply put it not to use it, as long as it's in current account. I can use it at any time. Even after 3 years also I can use it, but it is available immediately. Only if you have put it on deposit, fixed deposit, I have to consider the question of whether the original maturity period is 3 months or less. If it is 3 months or less, fixed deposit will be considered as cash and cash equivalent. If it is having a original maturity of more than 3 months, it is not cash and cash equivalent. It will be treated as other current asset. When it becomes an other current asset, because even in Schedule 3, bank balances other than above, other than cash and cash equivalent, you have to consider whether it is what is the maturity period. If the maturity period is within 12 months from the end of the reporting period, it will be shown as other bank balances under current category. If it is the maturity period is after 12 months from the end of the reporting period, you will show that under non-current asset, other bank balances. So for a cash balance, you don't have any time limit. If my operating cycle is 3 months, my debtors also agreed to be paid in 3 months, but after 3 months, so you should always, I have told you, if the operating cycle is less than 12 months, that condition is irrelevant. You have to go with the third condition, 12 months period. Okay. 2 operating cycle for the same industry, we have already done that. Thank you, Danya, for your explanation that it's a simple, be confident, be prepared, be work out. Whenever there is a requirement, get in touch with the Board of Studies. They will be extending all the help which is required. They will also use us for the purposes of getting into that. You can always get into this particular situation. Okay, then the tax paid under dispute, I have already explained that. A lot of companies offer warranties for 12 months. Warranty, whether it is a current liability or non-current liability, a very good question, Iman. I will tell you that if the warranty is expected to be settled within 12 months, based on the past trend, show that as current portion. If you believe that the warranty claims will be coming after 12 months, but normally the entity will be having a trend based on the past practice. On that basis, you can make an estimate that out of the warranty provision of so much, this is current provision which will be met, and the balance is for the subsequent period. Then we are talking about 5-year back reporting period, then whether we have to present balance sheet for 5 years. No, we have said only third balance sheet is required. Okay, whether the asset is wrongly classified as liability in the previous year, this will impact on the current year and the previous year statement. Ind AS 8 will apply. Any liability payable within operating cycle is current liability. Okay, that's we have discussed. Practical example of carve-in, carve-out we have already discussed. Debtors are realizable after operating cycle we have already discussed. And then doubt related to operating cycle has been creditors payment we have already explained. If any asset realized after the reporting period, then it is to be treated as current asset we have already explained. Pro forma financial statement is nothing but a projected financial statement for the subsequent period. So that is what is mark to market concept. Santosh, please wait that till Ind AS 109, then you will consider. Putable financial instrument, I am specifically not talking about that Samyuk because it is a completely new concept under Ind AS 109. So putable at the option of the holder will be treated as current. At the option of the issuer, it will be based on when you are actually going to put up that, the current and non-current. But if you ask what is putable financial instrument, wait for Ind AS 109 session. Share the Word file which has been already shared in Board of Studies. Categorize retention money. Retention money on performance guarantee on long-term project also. Say for example, retention money itself is due for recovery only after completion of the contract. So you have to assess when you will get that retention money. Within 12 months or after 12 months. What is your operating cycle? Operating cycle is 36 months. So whether you will get it within 36 months, it will still be current. If it is beyond 36 months, non-current. Suppose operating cycle is 9 months. Whether you will be expected to realize within 12 months, current. Beyond 12 months, non-current. So everything is based on that flowchart. That's the reason why I put that. Minal, thank you very much for your appreciation. That types of comments is actually making me to run further and further for the benefit of students and fraternity. Okay. Okay, this particular question on Amandip on when an entity breaches a provision of a long-term loan agreement on or before the end of the reporting period, within the effect the liability becomes on demand. But if you see the facts of the case which I have considered a case where it becomes negotiated for the subsequent period. So there is a small difference which is coming in. Suppose if the lender has agreed before the reporting date, that's the 31st March, then automatically it gets carried away. That's what my example which I have given. Suppose if it is not done before 31st March, what happens is that you don't have an unconditional right to defer settlement. It becomes a current liability. That's what Aman is mentioning. Somebody has also mentioned that. Putable financial instrument slide I have just now explained. Why the deposit shall not be treated as contingent asset merely disclosed in financial statement. Subham, I will just say, the moment you have already paid the money, there is no contingent asset, right? The amount has already gone out of your bank balance. So instead of bank balance, now it becomes an amount which was paid. That amount may be refunded to you or not refunded to you. To that extent, it's an asset in your balance sheet. Whether it will be refunded an asset or you have to provide for the entire thing as a liability in a particular scenario. For example, it will never be a contingent asset, right? It is an asset already in your books. Whether you have to charge it to P&L as an expenditure will be determined based on a subsequent order which is coming from the assessing officer. If the assessing officer subsequently says that, say for example, in our example, we take 100 rupees as a demand and I paid 20 rupees as a amount paid under protest. 20 rupees I show under non-current asset because the dispute is expected to be settled after 12 months from the end of the reporting period. I'm showing it as a non-current asset. After 2 years, if the assessing officer says that the entire 100 rupees has to be paid and you have also lost in appeal. So 20 rupees is not the asset. It is not only the expenditure. The balance 80 rupees should also be an expenditure. And accordingly, there is no current asset. The 20 rupees whether to be charged as an expenditure or can be treated as an asset. As at the reporting date, it is still remaining to be an asset. Okay. That's one thing which we are trying to find out whether it should be current classification or non-current classification. As far as the 100 rupees of demand which was outstanding, you have gone for an appeal. It is a current liability, not a current asset. It is a contingent liability and not a contingent asset. So contingent liability should be disclosed for entire 100. 20 rupees will be shown as an asset till such time the appeal has been set aside. That is what you have to understand. Definitely it is not a contingent asset. So I have answered all the questions which you are raised on this. Very, very sorry for the particular issue which came due to the connectivity issue. In case, if you are still having some doubts or still having some questions, you can post it in the Board of Studies website and they will send it to me. I will answer and ask them to upload the answers to you. And with that, thank you very much for being with me patiently. I will now give it back to Shilpa to take over and close the session.
Thank you, sir. Thanks a lot. Students, hope you have find these